सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तदेव शुक्रब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः तस्मिन् लोकः शतः सर्वे तदूनात्यधिकश्चन एतद्वैता 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 एतद्वैता.
Respected faculty of today's virtual seminar, CA Gururaj Acharya sir, past chairman and regional council member and ex-officio member of our branch CA Jomon K. George sir, and my dear professional colleagues, a very good morning to all of you. This month we have already conducted 3 CPE programs. The response for these programs are very encouraging. We need all your continued support and encouragement. We are planning to have a CPE program and a virtual study circle program during the next week. We are also planning to have a 4-day virtual GST refresher course with the GST and Indirect Tax Committee of ICAI starting from 6th June 2021. The details will be sent later on. We request all members to make use of these sessions. And I also request members who need any help can contact our CA task force. So I request you all stay safe and stay healthy. Coming back to our subject, the due dates of compliance with respect to audit is fast approaching. Hence, the management committee of our branch has decided to conduct a CPE program on audit. To handle the topic today, we have an excellent faculty on the subject, CA Gururaj Acharya sir, who needs no introduction. During the course of the presentation, sir will take topics such as important amendment for audit for financial year 2021, covering amendment in Schedule 3 and CARO 2020, Companies Amendment Act 2020, changes in CSR, reporting under CARO with respect to loans, investment, and guarantees and security, deposit, related party transactions, and ICAI announcements on accounting and audit. I must thank CA Gururaj sir for consenting to be the faculty despite his hectic schedule. On behalf of all members of the Thiruvananthapuram branch, I extend a warm welcome to you, sir. I also welcome our regional council member and ex-officio member of our branch, CA Jomon sir, and all other members of our branch who is watching the program virtually. Thank you, sir. Now I request Jomon sir to say a few words. Jomon,
thank you, Ramesh. Thank you. Good morning to all of you. Welcome, Gururaj sir, once again back to Kerala virtually though.
Thank you so much. God's own country.
Very dynamic and active chairman, Ramesh Kumar. Very able secretary, Rema. Sirianji, whom I can see on the screen, other managing committee members, and today is a very learned speaker, Gururaj Acharya sir, and respected senior members, past chairman of the Thiruvananthapuram branch, and close to 100 members who are virtually together for this empowerment program on company law, the recent developments. As the chairman rightly said, we are standing at the threshold of this audit season. Bank audits are over. Some of the very important listed companies, time-bound, some of the audits we could complete in spite of the lockdown and things like that, using better possibilities that technology is offering these days. And the larger number of audits are yet to be waiting to be done. So it's quite befitting that the Thiruvananthapuram branch is done, organize this program and bringing in an expert faculty like Gururaji for this. I always say he is Guru, he is Raja, and he is Acharya. And he's a very sought after, all of us know, a very sought after consultant practitioner in Bangalore. on corporate law, on taxation, so many topics. And in spite of all that, I think he's a role model that way, that he finds time for reading academics, I would say one step further, a lot of research, which would essentially be reflected in the presentation, which is going to unfold before us a few minutes from now. I don't want to take any much of your time this morning. Just thought I would log in. I would like to stay throughout, but then we have another program at the Ernakulam branch, which is I may have to sign off in between. So wish the program all the huge success that it richly deserves. And my compliments to the duo Ramesh and Rama for organizing such wonderful programs. I've been getting all the communication. Some of them I just logged in for some time, and all high value programs. Ramesh, the response is not just encouraging, the response is overwhelming. And in the Trivandrum Chartered Accounts group, the response that is coming, the guys that are coming, and thank you, they're coming are, innumerable. So keep going, all the very best. Proud to be an ex-officio member of the Trivandrum branch. And Gururaj sir, yes, the topic is there, 2021, all the changes that has happened, which is relevant for 2021. I'm sure that he would cover in detail. So once again, wishing you all the very best. Though triple lockdown is gone, COVID is not gone. So let us stay safe, stay determined, and stay hopeful while we are being careful that this too shall pass. We have lost many of our very dear friends. This morning also, a young member, he succumbed to COVID in Cochin. Ajit, who is a partner of our former chairman, PG Sajiv of the Ernakulam branch. Very young, he was only 46 or 47, very sad news. So let us not start on a sad note, let's pray for the soul, and let's be more careful and more supportive to people in need. So good day to all of you. God bless everyone. Thank you so much. Bye.
Thank you, sir. Thank you for the encouraging words. Now I request our Vice Chairman Charyanji Samuel to formally introduce Gururaj sir. Over to Charyanji.
Thank you, sir. Good morning, everyone. K. Gururaj Acharya hails from the temple town Udupi, brought in Iron City, Bellary, and is now well settled in the knowledge city of Bangalore. He is a qualified chartered accountant after completing articles under Messrs. Gurprasad and Co. Bellary. He is presently the senior partner of Messrs. KG Acharya and Co. Chartered Accountants, Bangalore, specializing in corporate finance, corporate taxes, and company law. He is a member of the Bangalore Financial Reporting Review Group, formulated under the Financial Reporting Review Board of ICAI New Delhi. He was a director on the Board of Directors of State Bank of Mysore, was a member of the Karnataka State Level Auditor Advisory Board, was a co-opted member of Expert Advisory Committee and Committee on Accounting Standards for Local Bodies by ICAI New Delhi. Authored a book titled Internal Financial Control Practical Handbook on Audit Report on What Can Go Wrong, published by Karnataka State Chartered Accounts Association. He is a resource person on accounting standards and standards on auditing, Companies Act 2013 and LLP, corporate finance and financial analysis, corporate tax and tax audit. With this brief introduction, we welcome you to this webinar. Over to you, sir.
Thank you, Charyanji, for that nice introduction. And I should really be honored today to be in the midst of the learned members of THIRUVANANTHAPURam. Thanks, Ramesh Kumarji, for giving me this wonderful opportunity of being with you. I also thank the Secretary Rima Sharma for being with us today and for being on the screen throughout. I want the Chairman and the Secretary to be there with me throughout, so that if there is any issue, I have company in that sense. I also recognize the presence of Padmanabhan, my good friend, who has been wishing me through the private box. I also am honored to be in the midst of very learned members like Srinivasan, Sridhar, and their whole family, Vijay Shri, who have all been there. Whenever I come to Trivandrum, they used to take me to the Padmanabha temple, which I truly miss. That is one part. While I'm always happy addressing the webinars, that's the best part is 3 hours session, only 3 hours is spent. But whereas the whole day or 1.5 days would be spent otherwise. But the flip side to it is that I don't get to see you in person, exchange, for that matter, socializing with you. I was also visiting the one and only Padmanabha temple. That is what I really miss. But at least I am honored to be in the midst of lucky people, because I call all of you as lucky, because you are very close to the great Vaidyo Narayana Hari. So I request all of you to pray on behalf of everybody, because yesterday in our office we had one particular thing, let us give a vision statement for our office. And then a lot of things came out. Then I suggested the best vision statement that we can have is Sarve Janaha Sukhino Bhavantu. I think there cannot be a better vision statement. Of course, for a business, I don't know whether it makes sense, but then why not? If it can make sense, otherwise, let everybody, let every participant, they say the employee, the employer, the vendor, etc., in all the commercial terms. But then if we are saying Sarve Janaha Sukhino Bhavantu, it takes care of not only the vendor, but the vendor's drivers also. I mean, it goes to that extent. So let everybody be happy. Let everybody be hopeful. I should really now also acknowledge the past chairmen of, I know, very good friends of mine, Rupesh, Revati, Anil Kumar, and of course, my good friend from Trivandrum, Suresh. Having acknowledged the presence of all of them, I acknowledge the one and only Jaiman K. George. Ramesh did a mistake of not informing me that Jaman will be coming for this particular session. I know he's...
No, sir, it is decided later only.
I know. Yeah. I mean, why I'm telling this is, if I knew that
Guru sir, if I may interrupt, I barged in, so not to be blamed. Ramesh, not to be blamed.
No, why I'm saying this is, if I knew that you were going to come, I would have prepared slightly more.
Oh my!
Normally we have leaders and
he's being very humble, sir. That is, he'll just log in like that and be with us.
I know he's like that. But then the point I'm saying is, we have great leaders, but we have resourceful leaders. I would acknowledge Jaman K. George as a resourceful leader of the institute. It's an honor to be there with Jaman today. At least.
Thank you, sir.
And I particularly liked the caption that you mentioned: "Be hopeful yet careful." I think that's a fantastic statement that I got to know from you today, and that's a very message that you, in very short and sweet message that is. And I'm glad that the Trivandrum branch has got something called the CA task force. When Ramesh mentioned that any assistance that you need, I think that's the best thing that can happen amongst the members, because if we can help each other, maybe by, I was seeing some of the companies are giving food to their employees when all the entire family is affected. Like that, maybe if the branch is also able to say, for a particular family, if they are totally affected, the branch will send them the food or things like that. So this is the general opening remarks. Having said that, I will come to the topic in particular today. I'm going to talk about a vast syllabus. I mean, this is a very vast syllabus. When Mr. Ramesh Kumar talked to me a month ago, he told me to talk about audit reports and CARO in particular. But then I said I will extend the menu to more than the audit reports, because audit reports, there has been no big change in the audit reporting format for that matter. It would be better if we come to know of the entire amendments or the important amendments which have to be taken into account while I'm doing the audit for the financial year 2021. We know what are the things that have already happened. Till last year, we have already known. So what are the changes that have happened between last year to now for us to know that, which are very important when we have to do the audit for the financial year 2021. Although my focus will be on the company corporate audits, it could also be used for the non-corporate audits also. So that way we have a vast syllabus. Of course, we have 3 hours in front of us, out of which 15 minutes is already gone. Having said that, we will be dealing with accounts, we will be dealing with audit, we'll also be dealing with a bit of company law, which are all required for the purpose of audit. And I request all the participants, what a lovely number. Just now I see that 100 participants I have logged in. When the session started, it was 89. Then it went up to 92. Now it is 100. Whenever these numbers come, for me, these numbers look like 89 means beneficial ownership. 92 means annual return. 100 means extraordinary general body meeting. This is how you will have to tag and relate every number to a section in the Companies Act. That is how you become wiser. Having said that, we have 3 hours, but then after 1.5 hours, I will take a 5 minutes break. I would call that as a biological break. But in between, all the participants have to be very active, in the sense, if they have any questions, I want them to post it in the Q&A box. I have requested the secretary and the chairman to read out the questions at the appropriate question stations, which I will be taking every half an hour. So that is the way we go ahead. But what are we talking about today? The chairman has already told, we are going to talk about what is relevant for 2021 audit. The first thing that comes out, I mean, a lot of queries which are coming out every day. I get at least 10 mails and 10 calls to find out whether the revised Schedule 3, is applicable for the financial year 2021, which we are signing off. Let me tell you the good news, it is not. Let me tell you at the beginning itself, it is not applicable for financial year 2021. So can we rest? Can we therefore rest and not look into the aspects of Schedule 3? The answer is no. There are a lot of issues in Schedule 3 which we need to be prepared right now. We need to be prepared right now when we are doing the audit for 2021. Although it may be applicable for 21-22, we may have to be prepared for the aspects that will come for the next year by informing our clients, informing the preparers that look, there are a lot of information that is going to be asked next year, for which the 2021 will become the previous comparative, and that comparative has to be given. So therefore, when we are doing 2021, it would be nice if we have a dry run, what it is called. I mean, we may not be required to report it, but you have it in your Excel sheet so that the next year, the information which is asked becomes the comparative, which is sort of properly audited at this point of time itself. Having said that, 24th of March 21 was, I should say, a good day for the chartered accountants. Now, why do I call it as a good day? Because there was about a 43-page notification which came out of changing the Schedule 3. And if there is a 43-page change which has come, why do I call it as any change is not generally welcome, but this change I would say is a very welcome change, because in fact what had happened is CARO 2020 had already come, was issued somewhere in February 2020, but it was applicable initially for 1920, then they postponed it for 2021, and then they said it is applicable from the next year, that is 21-22 audits. Now, if you see the new CARO 2020, there were a lot of questions. CARO 2020 is a sort of a long form audit report, if you may have to say. It is becoming longer and longer by the day. But having said that, the CARO had a lot of questions to be answered by the auditor without such a question being posed to the preparer. There was no primary responsibility on the preparer or the company to compile that particular information. It was left to the auditor to ask to the companies. So it was sort of a secondary force which was put on us. So now, with the change in the Schedule 3, which is of course effective from the next year, CARO also, which is effective from next year, we have the responsibility primarily on the preparers to come out with a lot of disclosures in the financial statement, and then the responsibility is cast on the auditor through CARO to report whether those things have properly been complied with. So therefore, I would say, now I'm saying that this particular 43-page amendment which came out in the form of Schedule 3 is a sort of I would say we were craving for it, sort of. So let it come. So it has come. Now the primary responsibility is cast on the audit, the preparers, and the auditor through CARO will only go to say whether it has been properly done or not. Then in between this year, we also had, I will be touching all this. I'm just giving you the synopsis of what I'm going to talk today. Then there has been a change in the audit report, the change in the board report also. So again, the question is whether it is applicable, because the notification, which there were 4 notifications issued on 24th of March 2021, amending Schedule 3, amending the board report, amending the audit report, and making certain changed requirements for accounting. They said that whoever is preparing accounts in the computerized environment have to have a feature of audit trail without disabling that, without ever it being disabled. So they brought about 4 notifications. And the sorry part was, all these 4 notifications, they said, is effective from 1/4/2021. Now that brought out a lot of confusion whether 1/4/21 means all the financial statements, board report, audit report prepared after 1/4/21, which is signed after 1/4/21, or is it applicable for financial statements commencing from 1/4/21? So that was a big question that all of us had, and a lot of us wrote to the institute. A lot of us have written it to the MCA also. No clarifications, although has officially come. So all of us have now, unofficially spoken to the Central Council members of the institute who have unofficially spoken to the MCA, all of whom are of the opinion that it is applicable for the next year and not this year. I wish the notification was clear in that particular sense. If you remember in 2011, Schedule 6 got amended. Whoever were qualified at that point in time will remember that in 2011 also we had Schedule 6 amending the presentation format. They brought in a host of changes, and there the notification was very, very clear. It said that the revised Schedule 6, the notification came somewhere in February 2011. It very clearly said the amended Schedule 6 will come into play for financial statements commencing from 1/4/2011. So such a clarity was missing in this particular notification. Therefore, all of us had to rely on our hunch and rely on these unofficial calls. And therefore, I have already signed the balance sheets, not considering the Schedule 3 and the 24th March notifications. So these are the 4 important changes which we will be dealing in detail. Secondly, Companies Amendment Act. There were a lot of provisions in the Companies Act which got amended by virtue of Companies Amendment Act 2020, which we have to take care of when we are doing the audit for financial year 2021, especially the CSR provisions, especially those of you who are the companies which are a class company requiring to spend under CSR. Then we will also go into the reporting of CARO 16. I'll be talking about CARO 16, which is relevant for the audit of 2021. In that, I have chosen, because some of the questions are straightforward. Are there any disputed taxes payable? That does not require too much of a discussion. What we have been doing, we must continue to do. Are the property, plant and equipment in the name of the company or some other names? So all these are straightforward questions. So I'm not looking into the straightforward questions for which any person can answer. But what is the interplay between CARO and Companies Act? In that, there are a lot of interplays, but I have chosen for today to discuss on 3 aspects, which is loans, investments, guarantees, and securities, which is actually section 185 and 186. I will also be talking about deposits from 72 to 76. I will also be talking about related party transactions, that is section 188. So that will be then of course there are a lot of ICAI announcements which are relevant for the audit for the season 2021. Also, we'll also see some other aspects which have got changed, like MSME, like the MSME classification itself has got changed. And also there has been certain last year because of COVID relaxation from Reserve Bank of India. So how are all those things going to affect the audit for the financial year 2021 is what we are going to see. So this is the overall menu, and I have given you a synoptic view of what will be discussed through the day. Now I'll put up my presentation proper. Ramesh Kumarji, is the going good?
Yes, sir. Yes, sir. It's okay. Yes, sir.
You're able to see my presentation. Now I
yes,
will.
sir.
Yeah.
Sir.
So the menu for the day, which I've already mentioned, and it is now coming in writing. So we'll first of all get into amendments in Schedule 3 and CARO. Amendments in Schedule 3 and CARO. So as I told you, 24th of March was a great day for us. With every change, there is an enhanced responsibility. Posting on the one side, like what mentioned as being careful, but every additional change will give us an additional opportunity of going in life. So being hopeful in that sense. So on 24th of March, there were 4 notifications bringing about revolutionary changes with respect to maintenance of books of accounts, disclosure in the auditor's report, disclosure in the board's report, and Schedule 3. Briefly, I will be touching about this. but again with a warning that this is not applicable for financial year 2021, and that's why I'm saying the applicability. When are all these 4 notifications applicable? Notification mentions effective date as with effect from 1st April 2021. And this is what we keep seeing, that over a period of time, I would not like to use that word, but then there has been an intellectual depreciation. There has been an intellectual impairment. I wish this particular notification was as clear as it was in 2011, so that we don't have to spend unnecessary time in finding out whether it was applicable for 2021 or 21-22. So there was a doubt whether it is applicable for 21-22 or 2021. However, we have, as I told you earlier, reached a consensus that it is with effect from financial statement commencing from 1st April 21, that is 21-22. Imagine if it were to be applicable for 2021. Imagine for a moment that if it were to be applicable for 2021, we have already, so many companies have already signed the balance sheets. There has been no guidance from the institute on how to prepare this. And imagine for 2021, 1920 becomes the comparative. We may have to give. In fact, let me tell you the good news. The good news is how many, I told you 43 pages, but out of the 43 pages, first 10 or 12 pages, I think it is about 10 or 12 pages, to be precise, let me tell you, it is about, 9 pages. I'm sorry, it is about how many for division 1? I was just trying to find out. For division 1, we have about 11 pages. Division 2 and division 3 included, it becomes 43 pages. In fact, what is division 2 of schedule 3? Division 2 of schedule 3 talks about the format of balance sheet and profit and loss account to be prepared in the case of an Ind AS company which has to present under Ind AS has to use division 2. Division 3 is to be used by a company which is following, and which is an NBFC. For all other companies, division 1. So division 1, I'm going to talk now, because division 2 and division 3 changes are only incremental changes, 1 or 2 changes in that. Otherwise, all the changes of division 1 is there in division 2 and division 3. And there are a couple of changes required in division 2 and only 1 change in division 3. I'm not touching that in detail. But having said that, imagine and also find out how many number of pages is one, number of pages of notification is one thing, but how many changes? In fact, I have totaled it up. There are about 10 changes in terminologies. For example, tangible assets are now called as property, plant and equipment. Then the term loan repayable within 1 year, instead of classifying it as other current liabilities under current liabilities, it has to be now shown as short-term borrowings. I call such things as changes. There are certain changes and 25 additional disclosures required by a company, 25 additional disclosures. Now imagine for all these 25 additional disclosures, we should have computed the previous year figure for 1920 if it were to be applicable for 2021. So all these have gone to the making that since the notification was given on 24th March, we did not have time to prepare all this. So therefore, we have reached a consensus that it is applicable for next financial year. But as I already told you, although it is applicable for next financial year, tell your office to prepare the figures for the current year, because the current year becomes the comparative previous year when we are doing the financials for 21-22. Now, is Schedule 3 applicable to the revised Schedule 3 applicable to all companies? Unfortunately, it is yes. If you look at CARO, there are exceptions to small companies, exceptions to certain class of companies. But Schedule 3, the revised presentation is not applicable to, is applicable to all the companies. Let's touch about CARO. CARO, we have seen various versions, but the current version, what we have to do for financial year 2021, the audit which we are doing now, we have to use the CARO 2016 model. If I may have to use CARO 2016 model issued on 29th of March. How many clauses are there? There are 16 clauses in CARO 2016 to be commented upon. But if you take the ABC, the sub-columns into account, you will have to answer 23 questions. So we will be going into a few questions when I get into the CARO 2016 proper. But CARO 2020, for that matter, has got 20 questions. Ramesh Kumarji, I was thinking that every 4 years, they are coming out with a new CARO, and every 4 years, they're adding 4 points. CARO 2020 is now 20 points as against 16 points in CARO 2016. But If it were to be only 20 points, I would have been happy. If you look into the ABCs, the sub columns within that point 20, there are about 48 questions that we need to answer. And in a consolidated financial statements, it will become 49 questions to be answered. So let us be aware of that. Again, CARO 2020 is applicable. Originally, when it was issued, it was applicable from 1920. Now it is applicable from financial year 2021. I mean 21-22, that is next year. Whereas CARO 16 is what we need to use. Who need not prepare CARO? Who need not prepare CARO? The good news is both in CARO 2020 and CARO 2016, the exempted category of companies are the same. They have not changed the type of companies which need not prepare CARO. So let us for a moment understand who has to prepare it. All companies have to prepare, including foreign company, government company, and a branch company. And a branch company in that sense, if it is incorporated as a branch company, except banking and insurance companies, Section 8 companies. So what is a Section 8 company? Rimaji, Section 8 company is a erstwhile Section 25 company of the 1956 Act, which people normally say not for profit, but that is not the right way to say. It is not a not for profit. A Section 8 company can make profit. A Section 8 company is a company registered where the profits earned are plowed back to achieve its own objective rather than giving it out as dividends to the members. So that is an important point about Section 8 company. Section 8 company need not prepare CARO. OPC and a small company need not prepare CARO. OPC and small company need not prepare CARO. A private company having no subsidiary or no holding company, not being a subsidiary or a holding company of a public company, subject to the following. A private company whose paid up share capital and reserves and surplus, if I may have to call it as net worth, if the net worth of the company is less than 1 crore and the borrowings from banks and financial institution is less than 1 crore and their total turnover, total revenue is less than 10 crores, all the three cumulative, any one of them breaching CARO will be applicable. Let us be very clear. So the first condition is in a private company, if the net worth is less than 1 crore and the borrowings from the banks and financial institutions, BFI, I call it, banks and financial institution is less than 1 crore and the total revenue is less than 10 crores, then you don't have to prepare CARO. Another good news is if any of them breaches, let me tell you another way of putting it, if any one of them breach, but if the company is a small company, if any one of them breaches, then I don't have to prepare a CARO. Now to put it differently, in the case of a private limited company, I will draw a flow chart in my mind. I will say, is the company a public company? Is the company a public company or a private limited company? For a public company, prepare CARO. For a private limited company, the first test I will do is it a small company? If the answer is yes, I don't have to prepare. I don't have to go further. I'll just say CARO is not required. If the company is not a small company, being a private limited company, then I put this test. Is their net worth, borrowings from banks and financial institution is less than 1 crore each and their turnover is less than 10 crores? If the answer is yes, then I don't have to prepare CARO. Otherwise, I have to prepare CARO. Am I clear, Rameshji? Yeah?
Yes, sir. Yes, sir.
Now the question that comes out is, what is a small company? They have amended the definition of small company. They have amended the definition. A small company is a company which is a private limited company, not being a holding or a subsidiary or a Section 8 company, and whose paid up capital is less than 50 lakhs and turnover is less than 2 crore up to 31,321. From 1,421. So from 1,421, the limits have got increased as far as paid up capital is concerned to 2 crores. That means even if the paid up capital is up to 2 crores, they don't have to, they're called as small. And in fact, it is a cumulative condition. Any one of them breaching, they will not be a small company. Turnover is less than 20 crores. Now I will give you a situation. The paid up capital is, let us say, 40 lakhs. The paid up capital is 40 lakhs. The turnover is, let us say, 1.5 crores. Paid up capital is 40 lakhs, turnover is 1.5 crores for this year. For this year, should I do the, when I say this year means I am talking about 2021, should I do CARO for that company, yes or no? Rimaji, can I get your answer, please? I'm here giving you a situation. Paid up capital of the company is 40 lakhs. The turnover of the company is, let us say, 1.5 crores. So it will be a small company. It will be a small company. I don't have to prepare. Let us say in this company, the actual borrowings were more than 1 crore. The actual borrowings were more than 1 crore. I will look in, if in normal situation, if it were to be more than 1 crore, CARO is applicable. But since it is a small company, I don't have to prepare CARO. That's the first point to be noted. The second point, can I say that when I'm signing this particular financial statements, now I'm giving another company, company B, whose turnover, company B's turnover is, let us say, 11 crores. Company B's turnover is 11 crores as of last year. As of last year, turnover is 11 crores. And their paid up capital is, let us say, 40 lakhs or 1 crore. Let us say that. Will we prepare, and their borrowing is more than 1 crore. Will we prepare CARO? Let us be very clear. The revised numbers of CARO is also with effect from 1/4/21. So I will look into the enhanced limit or the liberal limit for the purpose of classifying it as CARO when I do the audit of 21/22. Is that clear, Rimaji? No, let us be very clear, because if somebody asks you, Rameshji, if somebody asks you that, why are you doing CARO? Because, with effect from 1/4/21, with effect from 1/4/21, the revised limits have come into picture and you're doing the audit now. Why should you prepare CARO? Means, since we have used the logic for 24th of March notification with effect from 1/4/21 means with effect from financial statements commencing from 1/4/21, we have to use the same logic for application of CARO, yes or no. Okay, if a company converts. Now let's now spend some time in understanding what are the changes which has come forth in CARO 2020. There are, I told you, 20 points plus one more point for a consolidated financial statements, totally talking about 49 points. In fact, there are certain newly added points. Our institute has come out with a guidance note on CARO 2020 already. We can read that, but mostly it will be useful for next year. The newly added points are there any unrecorded income disclosed in the income tax assessments properly recorded in the books? A very straightforward question, so I can answer this. Now, the next question is very, very difficult. Does the company have the ability, looking into the ratios, the financial position, the other features surrounding the company? You have to comment as an auditor as to whether the company has the ability to meet the liabilities which are going to fall in the next 1 year. When I should come to Trivandrum and learn astrology. I mean, I know that Kerala is good in astrology for that matter. So that's the only way I can answer this particular question. So there is a question like this in CARO 2020. Very difficult to answer, but we need to answer this. And the third question is on it's not serially in that number. I just said one of the aspects that is asked about is whether the company is required to spend CSR and have they spent it or have they transferred the unspent amount to the fund. Now, section 135, as I already told you, got amended long back, but then it came into force from 22nd of January 2021, where, like in the case of a dividend, if there is no claimant for a dividend, if it is an unclaimed dividend, that amount cannot be kept in as a super profit for the company. It has to be deposited in the IEPF, Investor Education Protection Fund, with the government, with the central government, which they will use it for investor, enhancement of their knowledge and things like that. Now CSR also, they have, originally when CSR came, they said spend or report, spend or report. Now they are going to say in section 135, it is spend, or if you are not spent it, you have to transfer the unspent money to the government's fund, Then they have given timelines. By the end of the year, if you are not able to spend everything and you have an ongoing project, you can use it for that ongoing project. But they are very clearly told in 135(6) that if it is for an ongoing project, you will have to park it within 30 days from the end of the year. That is, within 30th April, you should have parked it in a separate bank account. You should have parked it in a separate bank account, and you have to spend it in the next 3 years, failing which you have to transfer it to the government's unspent fund. If you don't have an ongoing project, then the unspent amount, like in the case of 43B and 40A1A, they have given time for till you file the income tax return. In the case of unspent amount, where you don't have an ongoing project, you have been given time to deposit into the government fund within 30th of September. I mean, within 6 months from the end of the financial year. So that has already kicked in for 2021. So we as auditors have to report whether CSR is properly transferred to the fund, to the unspent account as required under section 135(5) and 6. So this, however, we don't have to report in CARO 16. It is required in CARO 2020. We also have to report on statutory auditors' resignation reasons. Have you considered the justifications as to why he has resigned, and have you rectified all those things before you accepted the assignment? Now, proceedings under Benami Prohibition Act needs to be told. Consolidated financial statement reference to negative remarks in subsidiaries CARO has to be commented. That is the one additional point. Internal audit system and cash laws has to be commented. They have also modified certain things. Inventory, whether there has been a variation between the books and what has been given to the bank by more than 10%. Also, they have gone to the extent of asking whether in the case of a company which has borrowed more than 5 crores, every banker will ask for quarterly financial statements. Not every month a banker will have to be given to fix up the drawing power. They have to be given stock statements. But a borrower who has borrowed more than 5 crores, he has to submit quarterly financial statements. That is, it's not called quarterly financial statements in the bankers' language. They call it as quarterly information system, QIS, or some banks call it as financial follow-up reports, FFRs. Now our MCA is calling it as quarterly information system, which is given to the bank, which consists of turnover, profits, stocks, receivables, creditors. Now, so many things like that. It's nothing but actually a financial statement which is given on quarterly basis. Now, based on that, the banker is going to now decide whether the company is healthy on a ongoing basis. Because normally what happens is by the time we give the financial statements, it is stale. I mean, the company would have almost come to a dead stage if in the case of an NPA. So they would like to know the pulse of the company on a periodic basis. So that is how the quarterly information system helps. So that is what they used to take it. That was there for a long time. What has been changed? 2 changes have happened. In CARO, they have told us that this particular information which is given, an auditor has to certify whether that information is in agreement with the financial statements of the company. Now, that is a very huge task, because companies actually don't prepare quarterly financial statements, but we are required to comment on this particular aspect. Then 189 deposits, then term loan if diverted, are there any defaults in repayment of dues? Have the term loans availed been diverted? Have funds taken? Has it been taken to meet the funds taken to meet the subsidiary, associate, and joint ventures obligation? Also needs to be commented. Reporting on frauds, Nidhi company registration with Reserve Bank of India. Some changes have happened. We are not going to deal with this. But when I retained all these things, deposits have been retained, cost records, 185, 186, and related party transactions, non-cash transactions, payment of statutory dues have been retained. What has been deleted in the new CARO is managerial remuneration. Let me tell you, managerial remuneration, there is a restriction as to how much you can pay to the persons managing the affairs of the company. Section 197, Schedule 5 of the Companies Act controls that aspect. There was a requirement in every company this to be reported. First of all, 2 things we have to note. Section 197 Schedule 5 does not apply to a private limited company. It does not apply. There is no restriction as far as how you can give any amount of remuneration to in the case of a private limited company. There is no restriction as long as the board has approved it. Now, having said that, in 197, there has been an amendment in 2017 itself where they said if there is any breach, I mean, any remuneration, managerial remuneration paid in excess of what has been specified in 197 has to be reported under section 143(3), has been told in section 197 subsection 12. It has already been 197 subsection 16. It has already been told, and it has already been told that it should be reported. So if a matter is already reported in 143(3), its reporting again in CARO was a repetition. So therefore, they have deleted that in CARO 2020. Now, why am I talking about CARO 2020? And some of the things I have highlighted in red here, we need to know that although CARO 2020, let me be very clear, although CARO 2020 is applicable for reporting next year, it is on the financial transactions of what is happening currently in 2021. I mean, in 21-22, from 1st April 21 to 31/3/22, whatever is happening during this period gets reported in this new CARO 2020 format. So we need to educate and tell our clients that these quarterly financials which you are giving to the bank, if on 30th June 2021 when they are giving, better be aware of this particular requirement. I'm going to comment if there is a deviation, if there is a significant deviation from what you have given and to your books of accounts. So please give those information from your books of accounts itself. Please go give it in the books of accounts itself. Don't give a hypothetical, because all these days, I would not say most, some of the companies used to work backwards. Whatever was the drawing power required, so much of stocks, they used to show it in the stock statements and quarterly information statement, although that information was not there in the books of accounts. Now, if such a thing happens, they will be taken to task by the bankers. And once this gets reported by the auditors, even the MCA could classify such companies as 447 cases. Now, Rimaji, when we were talking about numbers, we started off with 89, 92, 100. Now there is one very serious section called section 447. If you open up 447 of the Companies Act, it defines who is a fraud. Who is a fraud. So a company which has given a figure in the quarterly financial statement, which is much more than what is there in the financial statements, can be taken to task by MCA also, and also by the, of course, by the bank anyway, that they will be considered as fraud. For the purpose of drawing, they have given a wrong information. Now, these are all the things which we have to note now, because it will be reported next year. Inform your clients that these are all the changes that is going to come. Having said that, then is one more important thing. I have marked certain things in red here. The ones which are asked in red are the ones which are now also required in Schedule 3. In Schedule 3 revised, most of this information is now primarily, because I cannot say if it is unrecorded, CSR, proceedings of Benami, this quarterly information. First, the company should say whether it is properly given. Then I will report whether what they said is correct or otherwise. So these are the ones in red are ones which are appearing in the Schedule 3 revised, applicable for next financial year. Let me give you the gist of amendments for 24th of March 2021. Accounting software, they have told, and from when it is applicable. I have put it in my own way as to from when these are things applicable. Accounting software, whichever company is maintaining their accounts in the computerized environment, that books of accounts shall have a feature where there will be an audit trail, for any changes that happen, and such an audit trail feature shall never be disabled even for a second. Now, this was originally meant to be meant for commencing from 1/4/21. Then they said, because they gave the notification on 24th of March and said such a feature should be built into the software from the next 7 days, within a week's time. The companies went in for a riot and they said it is very difficult for us to change the system at this point in time. Therefore, they gave 1 more year's time. So this new feature has got to be in place by 1/4/2022. So what is the action point for the chartered accountants? We have to tell all our clients to have such a feature in their accounting software. Now the question is, what happens if I don't do this? It will be reported in the new audit report. In the new audit report, if you look at point number 3, item number 6, the audit trail on the accounting software, I as an auditor have to say whether there has been a feature built in the software to have an audit trail, and such an audit trail has been systematically been carried out throughout the year without it being disabled. I will have to comment there. If there is, well, it is a matter of good internal control. I mean, most of the companies we anyway would have insisted as a matter of good internal control. But having said that, this is now coming in as a compulsion. It is coming in as a compulsion. What are the points to be noted? What are the advantages? Now, once an entry is made, it cannot be changed. If you change, I mean, that is if you change it, the system will show what are all the changes that have happened after passing the original entry. So I always suggest that it is a good practice to pass rectification entries than to go and change the original entry. That would be because if you remember in our own accounting syllabus, we had rectification of entry, but in real life practice, unless it is a case of an ERP or such audit trails being there in the software, we try to change the original entry itself whenever it happens. But the right thing to do is you'll have to pass a rectification entry. That would be the best thing. However, if there is a need for you to change the original entry, that change will be noticed if you have this particular feature. Now, what are the reasons that you change? Like maybe let me tell you the reason for this. Now you relate this back when we have this quarterly information system and the auditor commenting that the books are in agreement. Now, some of the companies will now be saying, for the purpose of 30th June, 30th September, 31st December, I will pass some entry. I will pass some entry to make the quarterly financial statement look attractive. But on the next day, I will change it. Change it. So this particular facility will go on to probably identify that what are all the mischiefs that the company has created. There could be genuine reasons. If there are genuine reasons, I'll put it under the green drum. But if it is for any other reason, then I will put it under the red drum, and I will find out what is the reason for such a thing to happen. Is there any mischief or a fraudulent practice itself? Now that is the point number 1. Our action point is that we'll have to tell our clients as soon as possible, latest by 1/4/2022, this particular feature should be enabled in the accounting software. Schedule 3 changes, host of changes. Today, I'm not talking about that in a very detailed way, but let me just touch upon some of them. One is aging of various items in the financial statements have been asked, such as trade payables. Trade payables, you will have to give aging less than 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. Trade receivables, all these days we used to give aging less than 6 months and more than 6 months from the due date from which it is required to be received. It is not from the due date from the date of billing, but from the due date from which it is required to be received. Are they outstanding for more than 6 months and less than 6 months? Now they have gone in for a greater a granular detail, like not only less than 6 months, 6 months to 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years outstanding for in that particular thing. Then under that, disputed, undisputed. Under that, we have to say disputed, doubtful, disputed, good, undisputed, doubtful, undisputed, good. So like that, we'll have to give 4 classifications. And even for trade payables, I have to further classify it as disputed dues, undisputed dues, further broken down into disputed dues, MSMEs, and non-MSMEs. So that is a granular detail in which they want this particular information. Also, capital work in progress and intangible assets under development, they want the breakup. They want the breakup in terms of how many years it is there lying as capital work in progress and intangible assets under development. So they want this particular feature to be this particular breakup to be given. Also we have to mention in the financial statements, are there any cost overrun or time overrun with respect to the capital work in progress and intangible assets under development. Now this brings a very important point. I'm telling it as an action point, that now we'll have to tell our clients that for every capital project or intangible assets which is under development, they shall have a cost budget and a time budget, because I can comment about the cost overrun and time overrun only if there is a budget in terms of costing and in terms of timing. So that is what needs to be told there. Then they've asked us to, in the financial statement, to give 11 ratios. 11, all these days in the private, in any company, we used to give one ratio, that is earning per share. Now they have asked us to give 11 additional ratios, starting with net profit ratio, like the host of ratios, return on capital employed, return on investment, return on equity, inventory turnover ratio. Some of these ratios may also be asked in tax audit report. We have to ensure that both of them match. They have told that we have to give the numerator and the denominator used for that ratio. And one more thing that they've asked is, if there is a deviation as compared to the last year by more than 25%, you have to give reasons. So in short, your financial statement will now become a management report. It becomes a management report. So we should not only be good in numbers, we should also be good in explaining the deficiencies, if at all. I mean, it looks like we have to give a reason, even if it is favorable. That's the funny part. It is not only for unfavorable or adverse deviations, but even if it is a favorable, we may have to give the reasons. Mandatory rounding off. Those of you who are preparing Ind AS and NBFCs, you know that the round off, in fact, in Schedule 3, Division 1 also rounding off is required, but it is optional. So from now onwards, rounding off, in fact, rounding off to the nearest hundreds, it is not nearest rupee, nearest hundreds, thousand, lakhs and millions. If it is less than 100 crores, if it is more than 100 crores turnover, the nearest round off should be lakhs, crores or millions, like that. So all these days it was an option. From next year onwards, Schedule 3 will be a rounded off figure, and not the rupees in paises or rupee rounded off to the nearest rupee will not work. Details of Benami property held, conduit lending, and relationship with struck-off companies. All these things have to be reported from next year onwards. So what is a conduit company? I mean, conduit lending, they have used a very big terminology. Even an auditor will have to comment on that. Let me just take you to that particular thing which talks about auditor, what he has to comment, then it will be clearer for you. Although, let me again tell you, this reporting is required from next year, but the clients need to be warned about such a thing, so that if any such transaction is made during the current year, I'm going to report it from in the next year audit report. So ensure that the transactions are clean, so that my adverse reporting does not happen next year in my CARO and in your own Schedule 3. You only have to present it in Schedule 3 first, then I will report it in my audit report. The company's audit and auditors rules has got amended, wherein they have brought in E1, 2, 3, F and G. So what we need to comment in the audit report is whether the management has represented. Now look at this. If I will read this once, you will never understand. Then I will explain. Maybe you will, I mean, I'm sure some of you may have made an attempt, but if you're reading it for the first time, it's very difficult. Whether the management has represented that to the best of its knowledge and belief, other than as disclosed in the notes to the accounts, no funds have been advanced or loaned or invested, either in borrowed funds or share premium or any other source or kind of funds, by the company to or in any other persons or entities, including foreign entities, bracket intermediaries, with the understanding, whether recorded in writing or otherwise, that the intermediary shall, whether directly or indirectly, lend or invest in other persons or entities identified in any manner whatsoever by or on behalf of the company, ultimate beneficiary, or provide any guarantee, security or the like on behalf of the ultimate beneficiary. Look at this. It's like what you call Shankar Mahadevan's breathless song. Mahadeva only should come and help us now. In simple terms, let me tell you what it is. I, as a company, have given the money to Rimaji and asked Rimaji to in turn give it back to my own persons. So I have given it to an intermediary In fact, I am a company. I am the ultimate beneficiary. Look at this. I am the ultimate beneficiary. I have given it to a conduit or an intermediary, asking him, because I could not do it directly, because I cannot give it directly, a loan which I cannot give it directly because of 185 restriction, or a deposit which I cannot take because of section 72 restriction. I have done it indirectly. Then I have taken it through somebody, or I have given it to somebody. So that is the matter which needs to be reported. So I have given it to a conduit or an intermediary. Let me use the word intermediary now. I have given it to an intermediary, but I am the ultimate beneficiary because I am giving it to a person whom I want it to be given. So look at this. The auditor has to comment whether first of all, the auditor's comment is based on management representation. You look at point number 1 and 2, it is based on management representation. No management will say that I have given it through a conduit. But then still they said that you take a management representation. And point number 3, he tells you, you do your independent study and comment on that. Now, what is the question? Point number E1, whether the management has represented that to the best of its knowledge and belief, other than as disclosed in the notes to accounts. That means if a matter is already represented in the notes to accounts, and that's why I put this question, whether a special purpose vehicle is also a conduit requiring reporting under E above. This matter has to be resolved. I mean, on schedule, on a guidance note, on auditor's report, etc. And CARO on schedule 3 should be prepared by the institute. Once that comes out, there will be greater clarity. I will say that if a matter is already reported as an SPV in the financial statements, and I've told that I've given it to the SPV to in turn give it to him, then there is no problem. Otherwise, if the matter is not very clear, it has to be reported by the auditor like this. No funds have been advanced. I have not advanced or loaned or invested. These funds could have come from any source. It could be from borrowed funds, share premium, or any other source of or kind of funds by the company. I have not lent it by the company to or in any person or entity, including a foreign entity. The intermediary may be situated in Singapore, Dubai, anywhere. Normally it happens, this is what we call it as siphoning off funds out of India and getting it back in some other form there. With the understanding, whether recorded in writing or otherwise, the understanding between me and the intermediary may not be in writing, but it could be otherwise. That the intermediary shall, whether directly or indirectly, lend or invest in other persons or entities identified in any manner whatsoever by or on behalf of the company. Here the company is me, ultimate beneficiary. It is you invest in XYZ entity, which is actually my own company, or provide any guarantee, security, or the like on behalf of the ultimate beneficiary. So I have to make a comment on this from next year onwards. But on a transaction which is happening now, whether the management has represented that, the next point. Now look at this. Before reading this, I will explain, and then it will be easier for you in a single reading to understand. Now, if you are to be the auditor of the ultimate beneficiary company, E1 will come into picture. If you are the auditor of an intermediary company, where you have received funds and are giving it on behalf of the ultimate beneficiary, then point number E2 kicks in. Whether the management has represented that to the best of its knowledge and belief, other than as disclosed in the notes to accounts, no funds have been received by the company. No funds have been received by this company from any person or entity. The person could be a non-company also, including foreign entities, with the understanding, whether recorded in writing or otherwise, that the company shall, whether directly or indirectly, lend or invest in other persons or entities identified in any manner whatsoever by or on behalf of the funding party, that is the ultimate beneficiary, or provide any guarantee, security, or the like on behalf of the ultimate beneficiary. So point number 1 is for the company forwarding or ultimate beneficiary. E2 is with respect to the audit of an entity which is acting as an intermediary. So both these things are trying to cover up Benami transactions. While 1 and 2 is through a management representation, point number 3 is very serious. Based on such audit procedures that the auditor has considered reasonable and appropriate in the circumstances, nothing has come to their notice that has caused them to believe that the representation under clause 1 and 2 contain any material misstatement. This may be a very difficult point for the auditor to comment, because how will I know that in my books it may be looking as investments or it may be looking as loans, but how do I know that it is a Benami? I mean, I will have to be an investigator to comment on this. Let's see what our institute will have to say on when they come out with the guidance note. Whether the dividends declared or paid during the year by the company is in compliance with section 123 of the Companies Act, 2013. Section 123 of the Companies Act is one thing, it is plain. That means whenever dividends are paid out of profits, it doesn't matter. When the dividends are paid out of reserves, they have to be when the company has made a loss and they are declaring dividends, we have to be very careful. In some other session, I will talk reserves and surplus is not one item. Reserves is different from surplus. It may be very difficult. Surplus means accumulated balance in the profit and loss account. I can give profits out, dividends out of current year profits or out of past year profits. But if I've transferred the profits to reserves, then from that reserves, if it has to go back as dividend, there are a lot of prohibitions. So I'll have to see if a company has declared dividends out of the reserves. I have to look into the aspect very clearly and comment accordingly. The last point is, I already discussed this, whether the company, in respect of the financial year commencing on or after 1st April 22, replaced from the original 21, has used such accounting software for maintaining its books of accounts, which has a feature of recording the audit trail, also called as edit log facility, and the same has been operated throughout the year for all transactions recorded in the software, and the audit trail feature has not been tampered with, and the audit trail has been preserved by the company as per the statutory requirements for record retention. So I will have to comment on all this. So let me go back. Why did I say this? I talked about Schedule 3 and said details of Benami property held, conduit lending, and relationship with the struck-off companies. I will have to comment. Details of title deeds of land and building not held in the name of the company. Anyway, in the present CARO 16 also we have to comment on this. In CARO 2020, they have given a format. The same format is also asked in Schedule 3. Loans or advances in the nature of loans granted to promoters, directors, KMPs, and related parties. CSR details. Shareholding pattern. All these days we were giving of the shareholders holding more than 5%. Now we have to give the shareholding pattern of the promoters and the changes between the shares in during the year of the promoters has to be given. Whether details provided in quarterly information system QIS are in agreement with the books, if not reconcile with the reason. This is also, as I already told you, is required. Details of charges or satisfaction pending with reason. Now here I will have to pause. Whenever a company is giving a security, that security has to, a charge has to be created on that particular asset through in the register of companies by filing CHG1. And whenever there is a satisfaction of charge, I have to file CHG4 and get that particular charge removed. Now there is especially for creation of charge, we need to understand that there is a time, there is a window within which I can do. Afterwards, unlike in the case of AOC4, MGT7, all the normal things which we file, annual returns or balance sheets, if you delay it, you will have to pay it with additional filing fee. But the CHG1, the charge creation document, if you don't file it, you cannot file it. So that is how it is. So what is that? Within 30 days, you can file it. 30 days ke baad, you can file it in another 30 days. That means 30 days you file it with the filing fee. 30 plus 30 days, you can file it with additional filing fee. So within 60 days, if you cannot file it, the next 60 days, you can file it by paying not only additional filing fee, but a penalty in the nature of which will be tagged to the value of the loan taken. It will be ad valorem. It will be based on the value of the loan that you have taken. So within 120 days from the date of creation of the charge, if you don't file the charge creation document, you will never be able to file. And although the security has been given to the banker or the lender, a document has already been created, but if the charge has not been created, that particular security will be considered as unsecured loans in the books of the company. Auditor has to take that into account. Tomorrow, if the company goes in for liquidation, the lender will not have any additional benefit on that particular security as compared to a unsecured loan. So that is why they said in the financial statements, there must be a details of charge or satisfaction pending beyond the statutory date with reasons. Now we need to know what is the statutory date. Now I told you 30 days is one date, but in my opinion, up to 120 days, if it is not filed, then you will have to bring out in the Schedule 3. Disclose usage of borrowing from banks, financial institution not used for specific purpose. That means for the purpose for what it is borrowed. So these are all the major changes. I'm not going to talk about that in detail because I've got other things to say. Audit report changes we have already seen. Board report changes. in board report, there are a couple of changes, again applicable from next year. Application made or proceedings pending with the status under insolvency and bankruptcy code. Difference in valuation done during the one-time settlement and while taking loan from banks, financial institutions with reasons. Now let's see the applicability. In fact, in the audit report, one thing I forgot was specified bank notes. Disclosure with respect to specified bank notes is deleted. Anyway, we had deleted it because that was applicable only in 16-17, and afterwards it was only, it was not required. Therefore, we had already deleted that. Now it officially getting deleted from the rules. So that is the only change for 2021. If people are very particularly following that whatever is there in the whatever that 143(3) section that is there, I am reporting, then that you may delete it for 2021. Otherwise, last year only we are deleted. From 21-22, everything gets kicked in except the accounting software and the reporting with respect to audit trail in our audit report for next year. Year after that, everything will kick in. Are we clear, Ramesh Kumarji? Yeah, are there any questions? So that's the first question station that I will take now. If there are any questions, please. We have come to the end of the first topic, amendment in Schedule 3 and CARO 2020. Now I'll move to Companies Amendment Act 2020. Before that, if there are any questions, I will. If there are no questions, you can tell me, I'll proceed.
Sir, we can proceed, sir. In the last week, and if the member any post question. Yes, sir, we have posted. No, it is not there in the chat box.
Oh.
We will proceed, sir. In the last session, we can.
Sure. But again, I'll reiterate that any questions on matters which I have already covered, if there are there, please post it in the chat box. Otherwise, again, I will come at the end only for questions specific. Okay. So the next point is, okay. This is how the balance sheet, the audit report would look like. Or the audit report would look like this, report. This is a comprehensive audit report on the financial statements. Since I'm supposed to talk on audit reports in general, I will just finish off in one slide. Report on financial statement is the heading which I give. Then the second thing is report on other legal and regulatory requirement. The new ones which I've shaded in blue or light green, which you may call it, is the ones which will be applicable from next financial year. But for the current financial year, the other ones which are open-ended will be required to be given. The first one is it starts with an opinion. When the moment I see opinion, then that means it's a clean report. If it were to be, then it will be a report to be given under SA 700. If it is a report that is to be given under SA 705 or 706, when 700 and 706, then it will be opinion. If it is to be given under 705, then it is a modified opinion. Then the heading of the paragraph itself should say qualified opinion, adverse opinion, or disclaimer of a opinion. In para number 2, I will have to give the basis of opinion if it is under SA 700 or 706. But if it is given under SA 705, that is if it were to be a modified opinion, then the heading should be basis of qualified opinion, basis of adverse opinion, basis of disclaimer of opinion. And then I will give the basis. Normally, what could be the basis? Audited as per standards on auditing. I refer to the responsibility paragraph, refer to the auditor's independence, ethical, code of ethics, and I have also collected sufficient appropriate audit evidence for me to comment on the particular audit. Then I will talk about the third paragraph. I have put it in red, if needed. If needed. What does that mean? It means if apparently there is an issue with respect to the going concern, but the company feels there is no problem, we will be able to overcome that particular situation and we will continue to be an going concern. And auditor feels that is a fine justification. So he will have to give this paragraph and say there is a material uncertainty related to going concern paragraph has to be given. Earlier we used to give it under emphasis of matter or other matter paragraph. Now emphasis of matter. Now we have to give it separately under material uncertainty relating to going concern. What I give under this paragraph is, I will say that because the ratios are adverse, because the companies is into cash losses, their net worth is negative, there is an uncertainty with respect to going concern. However, The company has been supported by its holding company. They will be giving as much funds as required. So therefore, there is a problem, but there is a solution also. There is a mitigation to the problem. In that context, I will use this paragraph saying that although there is a material uncertainty, there is a mitigation for that. No worry. So I will have to bring out that particular point. However, if the going concern is affected, then the financial statement itself has to be prepared differently. That means on realizable value basis. Now, next point is emphasis of matter. Now, if there is any matter which is already properly dealt with in the financial statements, but they are of such a fundamental requirement which will be used by the which will be useful to the reader, then you bring out that matter. Let us say a contingent liability has been told very beautifully according to Accounting Standard 29, a disclosure has been given. But if the contingent liability is so huge that a reader would like to know about that being emphasized, because it is there in the midst of, let us say, 40-50 pages, the audit report will have to emphasize that particular point and say that there is a point there which you be aware of. So emphasis of matter to differentiate from key audit matter, emphasis of matter, subsequent event type heading can be used. Key audit matter applicable only to listed entities, telling us what is that matter which is so important, which was so important for audit and properly resolved. You bring it out 1, 2, 3, 4 points which were major issues when you dealt with the audit, and they have been properly dealt with. Applicable for listed companies mandatorily, but for others it is a option. So today I'm not going to the depth of it. KAM is told in SA 701. Please look into that. Other information. Please look into this. Other information is a paragraph which should be added by every company, including the private limited company. What is other information? Other information has been defined as information other than the financial statements and auditor's report thereon. And I always give this example. In the book of annual report of a particular company, there are audit report, there is a financial statement, there are other directors report, there may be management discussions, there can be some graphs, there should be some diagrams, newspaper cuttings, etc. All these forming part of audit report. Now this, from the annual report, you remove the financial statement and the direct auditor's report. Everything else is called other information in the financial statement. Now this other information, the auditor is supposed to read line by line and see if there are any inconsistency in what is there in the other information and in the financial statement which has been audited. If there is any inconsistency, it is the duty of the auditor to get it rectified, or if they don't rectify, to report it in the audit report. Now, what is the purpose? Let me just put it in a different way. There is a director's report where he says our turnover for the year is 700 crores. Whereas the turnover in the case of, in the audited financial statement, it is 650 crores. In the director's report, he says, last year we have grown by 20%, this year it is 700 crores. I mean, he may be including so many things in the turnover, but then that is not turnover. What is there in the audited financial statements should be there in the director's report also. So we have to now comment on that in the other information paragraph. Now, the question that comes out is, how will they give me that before I sign the financial statements? Well, SA 710 gives me a way out. Sorry, SA 720 tells me how this has to be dealt with different scenarios. They are given the reporting requirements. Accordingly, it has to be reported. Management responsibility paragraph, auditor's responsibility paragraph, other matter paragraph. What is this other matter paragraph coming out of SA 706, which says that if the auditor wants to give out certain information with respect to audit, let us say out of the 100 branches, I have not audited one branch, or out of the 4 branches, one branch was audited by some other chartered accountant. I have only taken his report and put it in my audit report. Anything like that, I want to say something has not been audited or something has been audited by others or something like that relating to audit, I bring it under other matter paragraph. Then the second aspect is report on other legal and regulatory requirement. CARO report under section 143.11, 143.3 auditor's report including IFC report, IFC report, there is exceptions provided to certain class of private limited companies. Otherwise, every company has to report. Other matters to be included in auditor's report as per Rule 11, pending litigation, provided for material foreseeable losses and long-term contracts, delay in transferring amounts to investor education and protection funds. SBN is removed now. So these are all the things that have come in with respect to audit reports. Shall we proceed, sir? Any questions?
Yes, sir. We can proceed.
Companies Amendment Act 2020 and changes in CSR provisions. So there have been a lot of changes in Companies Amendment Act. We will not deal with each one of them in detail. But what I will do is, I'll quickly run through everything, but then what are very important for auditors is what I will touch about. Direct listing of some of them, they've given the reasons also why they changed it. For ease of doing business, they have told direct listing of security by Indian public companies in permissible foreign jurisdiction. Certain private companies which list non-convertible debentures on stock exchange not to be regarded as listed companies. They've also come out with the rules, not very important for audit, although it is. Including provision of Part 9A, producer companies of Companies Act 1956 and Companies Act 2013. You may be surprised that until 11th of February 2021, 1956 Act was still prevalent for the provisions containing producer companies provisions. So only on 11th of February 2021, the provisions of producer companies came into 2013 Act, and 1956 Act now can rest in peace. So power to create additional or specialized benches for national company law appellate tribunals have been created. Lower penalties for all defaults for small companies, OPC, producer companies and startups. Not very important, but one point which I wanted to say, which I marked in yellow here is, if an auditor is appointed, ADT 1 has to be filed within 15 days. Who has to file it? The company has to file it. If there is a default, the company will have to face the music. But of course, I as an auditor, I will ensure that it is filed. Should it be filed every year? The answer is no. We are appointed for 5 years. That means it is once in 5 years, or whenever the change happens, it has to be appointed. It has to be filed by the company. Now, ADT 3, whenever an auditor resigns, it is the responsibility of the resigning auditor to file ADT 3. It is a responsibility of the auditor to file the ADT 3 with reasons. He has to give reasons also why he has resigned from the company. And this has to be filed within 30 days. Within 30 days from the date of resigning. If not, there are penalties for that. The penalties could be as high as 50,000 rupees or equivalent to audit fee, whichever is lower. It used to be higher amount. In Companies Amendment Act, it got reduced. It used to be 2 lakh rupees. And then it will say whichever is more was told. Now they said whichever is lesser. Let us say my audit fee is only 10,000 rupees and I have resigned from such a company. I need not pay 50,000 rupees. I have to pay 10,000 rupees. But why should I pay even 10,000? What could have happened in 500 rupees or 300 rupees? Why should I pay more? The point I'm trying to say is, if you are resigning, you should have proper reasoning. You should have, let me also use this word, proper reasoning. You cannot say I am in view of my preoccupations. In view of my preoccupations, I am resigning. And then once you file ADT 3, if you are so preoccupied, you should not file any more ADT 1s. Rimaji, are you able to appreciate that? If you are so preoccupied, why did you resign when you are filing ADT 1s afterwards? That can come in your way. You will have to be very, I would say, if the company says that we want to change the auditor because your fee is more, let us say, your fee is more, I would put that as a reason. The company has asked me to resign because my charges are high. Or if they say that, our group has been taken over by some other, normally this can also happen. Our group has been taken over by somebody, so they want the big fours to come or whatever. Then I will put that as a reason. Because the company's management has changed, they want to go with the holding company's auditor. I would like to put that as a reason instead of giving a reason which is smooth. Because this becomes, even CARO, as I told you, for next year CARO, the next auditor will have to look into this and give his opinion whether he has properly been appointed and previous auditor's resignation reasons have all been considered. So if there is a continuing default, 500 rupees per day, which can go up to a maximum of 2 lakhs. What was 5 lakhs got reduced to 2 lakhs. Now, decriminalization of the Companies Act defaults involving minor technical and procedural defaults. You may be shocked to know that CSR, if a company did not spend, the directors and officers in default could be imprisoned. When corporate social responsibility is sort of the government's job, which actually the company is performing. And for not performing that, initially they said CSR, you make or report, you don't, it's only a soft peddling, you may do it or you may not do it. Then they said, if you, for not complying with section 135, you will be imprisoned. That was taken very seriously. So they now said, we are decriminalizing some of the defaults. Decriminalizing means we will not be considering you as a criminal, rather it will be a civil dispute rather than a crime. Crime leads to imprisonment and a civil dispute always leads to penalties, if not fine. Now, what is the difference between a penalty and a fine? In fact, long back we used to discuss what is it. They have reduced lot of fine to penalties. A fine can be levied only by a court, whereas a penalty can be levied by other than a court also. So that a register of companies could not have levied a fine. It had to go to the court. So that is why they changed from fine to penalty in so many contexts. So compoundable offenses, declogging criminal codes, these are things which are normal. The changes in CSR, already we discussed, I'm just going to touch upon some of the points here. 22nd January 2021, please mark this date very importantly. A lot of changes, those who are having companies where CSR is required to be spent. Now, which are the companies where CSR? 3 conditions: 5 crores, 500 crores, 1000 crores. 5 crores net profit means profit before tax. Let us be very clear. Some of the companies can reach the threshold of CSR mostly through profits. In our office, we have seen 500 crores and 1000 crores is normally not there with every chartered accountant. 500 crores net worth, 1000 crores turnover. A higher threshold, but a profit of 5 crores per annum, that too before tax, most of the companies could have reached, private limited companies included. So if any one of these 3 conditions, any one of them, these 3 conditions, 5 crores profit before tax, 500 crores net worth, 1000 crores turnover, if any one of them breaches, the company is under an obligation to spend 2% of the profit before tax as CSR. Now that is where all known. It has been there since 2013. What are the changes? CSR committee was required to be formed, and a subcommittee of the board was required to be formed, and they should have dealt with the CSR aspects. Now they said, if the CSR spending is less than 50 lakhs, if it is less than 50 lakhs, they don't have to have a CSR committee. Rather, the board itself can do that particular function. The next thing that they brought in very interestingly is, if in year 1, why in year 1? In 2021, you have spent as against 2 crores. Let us say your profit is 100 crores. You should have spent 2 crores. And you have actually spent 2.5 crores. You have spent 2.5 crores. So the question was, this extra 50 lakhs what I spent, can I claim it as a set off in the next year? Can I claim it as a set off? Until this provision came, it was not possible. Now they said you can set off your excess spend in the next 3 years. In the Companies Amendment Act, they said in the subsequent financial years as may be prescribed. And finally, the rules have now prescribed that up to 3 years you can carry forward the surplus. Then penalty for non-compliance of subsection 5 and 6, instead of imprisonment, they went on to say, otherwise it was 50,000 imprisonment of a term extending up to 3 years. Now the penalty has been told not less. Please understand, if a company does not spend, the amount that is to be paid as penalty is, company shall be punishable with a penalty of 200% of the amount not so transferred, or rupees 1 crore. In my example, 2 crores had to be spent because the profit was 100 crores. They had to pay 2 crores or 1 crore, whichever is less. So that means 1 crore. And every officer in default shall be punishable with 10% of the amount not so transferred. That is 2 crores ka 10% is 20 lakhs or rupees 2 lakhs, whichever is less. Now, does the company, Rimaji, does the company have an option to just pay the penalty and not incur the CSR? Because I told you they have to spend 2 crores. Now here it looks like they have to pay 1 crore and 2 lakh rupees. 1 lakh, 1 crore and 4 lakhs. So instead of paying 2 crores, when I would not even talk about that. If the company has to spend better, spend. Penalties can always be you spend and again pay penalty. That could be the final. So the second provision, the 135.5, I spoke about it. Let me show it. If the company fails to spend 2%, board shall in its report specify reasons for not spending, and unless unspent amount relates to any ongoing project, transfer such unspent amount to a fund specified in Schedule 7. That fund are like IEPF. They have now called it as National Unspent CSR Fund. That is the fund name. Within 6 months from the end of the financial year, that is within 30th September. So in 2021, please look into this. If a company had to spend 2 crores towards CSR, it has spent only 1 crore and 25 lakhs. 75 lakhs has not been spent, and you don't have an ongoing project. I mean, normally a company will not say I don't have an ongoing project. So it will move to 135.6. If any unspent money, I will say that it is going to be, because I will get more time, 3 more years time. But please tell such a company that this 75 lakhs, if you don't have an ongoing project, you have to deposit in this fund by 30th September. But if you have an ongoing project, by 30th of April itself, you should have deposited it in a separate account. You know, that's a very important point to be noted. Transfer in 135.6, any amount remaining unspent pursuant on an ongoing project as per the company's CSR policy, transfer the unspent CSR amount opened with a scheduled bank within 30 days from the end of the financial year and spend within 3 years from the date. Within 3 years, you have to spend. Otherwise, within 30 days from the end of the completion of 3 years, you will have to transfer it to the National Unspent CSR Fund. Now look at this. A company which has not spent even 75 lakhs, if they have an ongoing project, they should have put it in the separate bank account by 30th of April. Companies have told that we have not deposited because of COVID and other things. Give us more time. And companies may get, this is the newspaper announcement which is saying, companies may get time to deposit unspent CSR funds with the banks because 30 days is too small. Now this, our institute came out with the accounting treatment of the 75 lakhs. Out of 2 crores, I spent 1 crore 25, 75 lakhs. Should I pass an entry on 31st of March? Our institute said at the end of financial year, a provision must be made on the unspent amount of 75 lakhs. If a company does not make a provision, auditors will have to qualify the accounts. So that is the current picture. Now, are there any further things to be noted? PM Cares Fund can also be CSR, COVID related R&D expenditure. Any company which is doing promotion of healthcare, including preventive healthcare and sanitation, is also considered as CSR. And undertaking awareness program or campaigns or public outreach campaigns on COVID vaccine program is also considered as CSR. And setting up makeshift hospitals and temporary COVID care facilities is also considered to be CSR. I don't want to get into the details, but one point to be noted is a company which is spending on CSR cannot claim that expenditure again under section 37 or under 35 AC, but could have claimed under section 80G. Could have claimed under 80G. Why I'm using the word could have is if such a company has given this money to PM Cares, it can claim under 80G. But a point to be noted is such a company should not be a company which has claimed the option under 115 BAA or 115 BAB. Because once you claim BAA, BAB, last year, financial year 1920, you could have claimed twice. PM Cares could be, you put it up to 30th June, I think that was the time given. They extended up to 30th June. For financial year 1920, you could have claimed that, and you could have also, you could have said that it is CSR, and you could have claimed it under 80G, even for 115 BAA, BAB companies. For this year onwards, but for this year, that means assessment year 21-22, financial year 2021, if a company is coming under 115 BAA, BAB, that is that 22% or 15% tax rate companies cannot claim deduction under section 80G. Now, what are the other important changes which have happened? Provision for window within which penalty shall be levied. This second point is very interesting. 129A, central government to prescribe certain class of unlisted companies who shall prepare their periodical, audited or limited review financial results and file it with the register of companies within 30 days of completion of the relevant period. Right now, every listed company has to prepare a quarterly financial statement and get it published. But now they are saying there could be certain entities which are not listed, but are of such a class that the central government is yet to come out with this particular. I would prefer that, any company which has a borrowing of more than 50 crores. public interest entities. They may not be listed in that sense. So they may have to prepare their quarterly financial statements, get it either audited or get it reviewed on a limited basis by an auditor and file it with the ROC. Just like AOC 4, they may be a AOC 1/4. If I may use that particular thing, right now we have AOC 4, now we will have AOC 1/4. So central government exempts certain class of persons from section 89, what we started off. Rights issue, there have been certain liberalizations. Filing of MGT 14, there has been certain liberalization. Non-executive directors and independent directors are also eligible for pay, which was not possible earlier. Now Schedule 5 has got amended to include non-executive directors and independent directors can also get salary as per the specification which has been shown here. Now, let me now quickly go to certain very crucial action points that are required from some chartered accountants if they're also advising the company on certain matters. There are two important action points. Okay, two important, not as auditors, let me tell you, not as auditors, but I thought I will just bring out this particular thing today. Application for seeking. A lot of companies have filed, last year we had up to December, a scheme called the CFSS scheme. All of us are aware. Companies, fresh start scheme. Whatever forms you have not filed, you can file now from whatever 1st of April to 31st of December without paying additional fee. No penalty, no additional fee. But such a company, was it exempt from prosecution? Did they get a vaccination from prosecution, if I may use that word? The answer is, the scheme said you will get a immunity from prosecution if and only if you file after the end of the scheme within 6 months, that is before 30th June, all such companies which have filed the form under CFSS by not paying the additional fee or penalties will have to file a CFSS 2020 form. Will have to file a form with the ROC. Suppose you have filed MGT 7, AOC 4, ADT 1, all three, then all these three will have to put it in one form, CFSS form, and file it without any fee. But if you don't pay, if you don't file this, there could be a possibility of a notice coming to you, the company, for prosecuting. So this is saying that, pardon me for the mistake, don't prosecute me. This has to be filed. The second important change is the annual returns of every company which has a website. The annual return of every company which has a website is mandatorily to be hosted on such a website. So please note this particular, from 28th of August 2020 this has come. So please inform all the companies to host if they have a website. If they don't have a website, then they don't have to host, but the director's report should have an additional MGT 7. But if they have a website, they don't have to give the MGT 9 in the board report, but they may have to give a link where it is shown in the website. So that's the point. These are the 2 points I wanted to say. Are there any relaxations due to COVID for companies? I mean, we have seen that board meetings through video conferencing is permitted. Board meetings can happen through video conferencing, but there are at least 5, section 179 goes on to say certain aspects of what can be dealt in the board meeting cannot be dealt through a video conferencing. It has to be dealt in a physical board meeting. However, from 19th of March 2020, they have been extending up to 30th of June 2021. I'm sure it will further get extended, that these aspects and also these 5 aspects can also be dealt through virtual meetings. Extraordinary general body meeting can be held on a virtual mode up to 30th of June. AGM extraordinary annual general body meeting also for the calendar year 2021 can be done through virtual mode or through other audio visual mode. 2020 CARO has been extended up to 21-22. INC 20 by newly incorporated companies, what was required to be filed within 6 months from the date of incorporation, they have given additional 6 months up to 12 months. Gap between 2 board meetings can be, normally should be 120 days. They have now told up to 120 days is also permitted for the first 2 quarters. At least one director should be in India. At least one director should be in India for more than 182 days. That provision they have relaxed and told not applicable for financial year 1920 and 2021. Yes, sir. Any questions? And then we'll take a 5 minutes biological break. Are there any questions, Ramesh Kumarji?
No, sir, it is not there. I think we have given the option to unmute at the end of the session, sir.
Okay, sure. Okay, great. So now it is 117. Okay, I think 117 members are very good. MGT 7 has to be filed. Okay, can I take a 5 minutes biological break? Is that good?
Yes, sir. Yes, sir. Of course.
Sure, sir, please.
Sure.
Now it is 12. I would see 12:12. So we'll assemble at 12:17. Thank you.
Sir, audible, audible.
Am I audible now?
Yes, sir. Yes, sir.
Shall we start?
Yes, sir.
I see a good number. Okay, circulation of members resolution. 111.
Yes, sir.
Okay, reporting under CARO with respect to loans, investments, guarantees, and securities. What we need to understand: deposits and related party transactions. These are three powerful sections in the Companies Act which an auditor has to be fully aware of. Now, what we need to understand is, in the case of a company, the basic is the owners are different from the people who are managing. So there are enough safeguards provided to the owners because the decisions are all taken by the managers. Now, what they have done is, if there is any loan, investment, guarantee or security, if there are any loan, investment, guarantees or securities which are given to the owners themselves, then that is very bad. So therefore, they have built in a provision to say, if there is any loan given to a director or a person connected with the director, then there should be a embargo. There must be an embargo. That is how section 185 has come. So loans cannot be given to directors or a person connected with the director. And there are certain relaxations we will see. What is 186? 186 is a control that I have given this money, the shareholders have given this money to the company to run its own business, But in turn, if they're using this money for investing or for giving it as loan or for giving it as security or guarantee to somebody, it could be one person or others. It could be an outsider also. Up to 60% or up to 100%, they have told certain limits. Up to that limit, you are well within the board powers to exercise that. But if you are exceeding your limit, that is called section 186 subsection 2 has given a limit beyond which the managers can actually perform, managers can invest or managers can give a loan to anybody else, including the directors, etc., including the exempted directors in that sense of 185. So 185 and 186 controls the loans given, the investments made. This is for giving. Taking. If the company has taken money, there are certain restrictions. The moment the name of a company is told, there are a lot of people who think that every company is actually owned by the government. There are some gullible investors who think that whatever a company means, it's very big. So therefore, if I give the money to that company, if they have assured me some 18% interest, they don't know that they will get only 18% and not the 100 rupees itself. So they don't know that the money which they are giving to the company is actually going down the drain. So whenever they are assuring high rate of interest, and if it is a company, they will always be thinking that it is safe. But therefore, for such gullible investors, there are safeguards built in through section 72 to 76. However, directors can give. You look at this, if you talk about a balance sheet, if the money is coming into the company, directors can give. But if the money is going out of the company, directors cannot take. I mean, that is the interplay between 72 to 76 and 185. Now, there are certain exceptions, we will see that. Then let's talk about related party transactions. Now, again, as I told you, the majority of the shareholders should be protected against the managers of the company, who could be called as managing directors, key managerial personnel or whatever. They're all related parties as far as the companies are concerned. So if there are any transactions done by the company with such related parties, as long as it is done at arm's length and in the ordinary course of business, then there is no problem. It can carry on. But if it is breaching any one of them, it is not at arm's length or not in the ordinary course of business, then of course they should take a board's permission. They should take the board's permission. It should come within the knowledge of the entire board. And if the transactions breach a particular limit, they should also approach the shareholders and inform them that, in fact, it is called a prior approval of the shareholders must be obtained before such related party transactions or high value transactions are conducted. So that in short is the reasoning behind all these sections. Now let us see the auditor's implication on these sections. The Companies Act 2013, that 143.3 main audit report. I mean, I was trying to make a research as Jaman K. George mentioned, how many sections are referred in the main audit report and how many sections are referred in the CARO. At least those sections we should be very familiar with if we are doing the audit of companies. So in the main audit report, there are at least 9 sections. Section 133, emphasizing on accounting standards and its importance. Section 134(5), where we say that the director's responsibility statement I have taken into account when I am giving the director's disqualification. 143(3), the main audit report itself. 143(3)(1), the internal financial controls with respect to financial statements. 143(8), I have considered the branch office accounts when I am doing giving the true and fair view on the financial statements. 143(10), which recognizes the standards on auditing. If I have not done the audit as per the standards on audit, not only will my institute take a disciplinary proceeding against me, the MCA as a regulator can also charge the auditor for not complying with the requirement of 143(10), as standards on auditing is now officially recognized in the Companies Act. 143(11) deals with CARO, which all of us are aware of. 164 subsection 2, disqualification of directors. Based on the written representation, I have to say whether the directors are all qualified or disqualified. And 197 subsection 16, which I mentioned, applicable only to public limited companies. I have to say overall managerial remuneration, whether they are paid in accordance with 197. So these are all the 9 sections which are referred to in the main audit report. Now let's get into the CARO 2016. CARO 2016, where there are a host of other sections referred to. 185, 186, we already saw that. Loans, investments, guarantees, and securities. 2 sections referred there. 73 to 76, I should be aware of this provision. Deposits, 4 sections. I mean, on the right side, I put the number of sections which I should be aware of, 4 sections. Section 148, maintenance of cost records. Who are all the companies? I'm not dealing with that today in detail, but I'm just making a passing reference right now. Which company should maintain cost records? They have segregated the entire companies, manufacturing companies and companies which are providing services. Companies which are engaged in trading are not coming under section 148. Only if it is a manufacturing company or a company which is providing services, they come under this. Then they have classified companies into regulated sector and 6 regulated sector and 33 non-regulated sectors. And they have specified turnovers up to which books of accounts have to be maintained. Mostly 35 crores and above books of accounts have to be maintained. And for different companies, they have told beyond a point, you have to get it audited. You have to get the books of accounts audited by a cost auditor. So cost audit, what we call. So you'll have to see whether your companies falls within the 6 regulated and 33 non-regulated sectors. If it does not come in this 39 sectors, then you are not coming under section 148, although you are manufacturing or providing services. So one section you have to be aware of. Section 42 and section 62 dealing with the preferential allotment or private placement of shares or convertible debentures. Let me spend some time. I have one slide which I will show you because that is important, but I'm not going to deal with that detail because every company may not have this particular situation. I have taken 3 important sections, 185, 73 and 177, 188, because related party transactions, deposits and loans probably will be there across most of the companies. So I will be dealing with the preferential allotment and private placement in one slide. 197, managerial remuneration not applicable to private limited companies, but applicable to public limited companies. One section, again, public limited companies have to see whether managerial remuneration is paid as per that particular ceiling as told in 197, read with schedule 5. 177 deals with the audit committee of the board. Wherever it is there, it is applicable. 188 deals with related party transaction, which we will see. 192, non-cash transactions with directors or persons connected with him. If I have taken something and given something to him where there is no cash involved, let us say I have taken machines and given shares, or I have taken services and I have given shares, something like that, then that is in case of a non-cash transactions. Section 192 says whatever you are taking, you have to properly value it through a registered valuer, and you will have to account for that in the books of accounts. And there are certain you'll have to make certain filings with the ROC. So that has to be properly followed. 192. I'm not talking about that either in detail. 143.12, fraud reporting. Whenever there is a fraud on the company or against the by the company, you will have to go in for fraud reporting under 143.12. So again, this I'm not going to talk about it. 135 we have already discussed. CSR, transfer of unspent amount, has to be told in CARO. But the point I'm trying to say is here, if you see, whatever is not underlined is already there in CARO 2016. If it is underlined, means it is an insertion coming out of CARO 2020. So 143.12 and 135 is coming out of CARO 2020. So for the purpose of 2016 CARO, you need to at least familiarize yourself with the 13 sections of the Companies Act. But for CARO 2020, you must be familiarizing yourself with 15 sections in the Companies Act. So that is the purpose of the right side 15 number. And are there any other reporting matters? Yes, there are a host of other reporting matters, 12 other reporting matters. Property, plant and equipment, inventory, we have already discussed. Unrecorded income disclosed in IT assessments, statutory dues, repayment defaults, application of funds raised by way of IPO and FPO, Nidhi companies, section 4, registration under section 45(1)(a). Let us be very clear here. Let me tell you, since I'm dealing with CARO in a small way, which is a company which is required to be registered under section 45(1)(a). We may be saying every NBFC. Every NBFC has to be registered under section 45(1)(a). Please understand, there is something called a deemed NBFC. A deemed NBFC is a company which a normal company can become a deemed NBFC. You know how? By applying the rule of 50-50 test. There is something called 50-50 test. Ramesh Kumar ji, you have heard of this 50-50 test?
No, sir. No, sir.
You know, if your company has invested more than 50% of its total assets in shares or in financial instruments, debentures, FDs and bank balance, they have excluded. Some of Reserve Bank of India has excluded that. But if you have invested in any financial instruments like shares and debentures, mutual funds, etc., and that means total, look at your balance sheet total. Balance sheet total is 10 crores. If you have invested more than 5 crores, more than 50% in a financial instrument, not being FDs or bank balances, and more than 50% of your revenue is from, such financial financial instruments. It could be by virtue of interest, mutual fund, it could be by virtue of dividends. Then such a company, although it is a regular manufacturing company, it becomes an NBFC. It is considered to be a deemed NBFC. An auditor has to comment on such a thing, where an auditor's responsibility, you know what? He has to comment on this particular provision. Why I did not bring it up is because it is 45(1)(a) of the Reserve Bank of India Act, not the Companies Act. The Reserve Bank of India Act wants me to report it here, and it becomes the requirement of the auditor to actually communicate with Reserve Bank of India saying that the company has defaulted in not registering it. The primary responsibility of such a company which is gone beyond the 50-50 test is to register with the Reserve Bank of India. And if they have failed it, I as an auditor should complain against the company with Reserve Bank of India that such a registration has not happened. That is Reserve Bank of India, and I have to report it here. Let me tell you, notices have been issued to chartered accountants from Reserve Bank of India saying why you should not be penalized, prosecuted for non-compliance of section 45(1)(a) because the company has breached the 50-50 test and you have not commented on such a thing in your audit report, or you have not complained against that company with Reserve Bank of India. So there has been cases like that. Therefore, I paused here with the big force. Now, ability of the company to meet liability in the next 1 year, we have seen this. Statutory auditor's resignation, consider issues, objections or concerns raised by the outgoing auditors. Internal audit system and cash losses have to be commented. So now I get into the 3 important sections of the Companies Act. In respect of loans, investments, guarantees and securities, whether provision of section 185 and 186 of the Companies Act have been complied with. If not, provide details thereof. Applicable even to private limited companies. This is applicable even to private limited companies. What does 185 say? 185 says loans to directors. 186 says, if you are giving any investments or loans or securities and guarantees, you shall be within the limit. If you cross the limit, you should take permission from the members. You should take special resolution. You should get a special resolution passed, and only then you can breach the limit. So let's see 185. 185 is a sort of a ban from giving. The company is banned from giving loans to directors. Now 185 was very harsh initially. In Companies Amendment Act 2017, they have liberalized this. So we'll have to look into the revised provisions. We have to look into the revised provisions of section 185, which in my own way I have presented here. They have said you classify the directors, firms in which the directors are interested, relatives of directors, or firms in which relatives of the directors are partners. Okay, this could be one categorization. That means, in short, non-corporate entities. And the directors could be interested in a company either as director or a member. So I have classified the entire thing as non-corporate entities and corporate entities because the rules are different. If I am giving loan, I cannot give loan to directors. Not only directors of my company, I cannot give loans to directors of my holding company. Can I give loans to the directors of my subsidiary company? The answer is yes, if they are not directors in my company or in my holding company. That is the general understanding. Now, having said that, next, I cannot give loans to any partners or relatives of such directors. Suppose a director is also a partner in a firm. You know, X and Y are partners, and X is a director in my company. I cannot give it to Y, or I cannot give it to the relative of. I cannot give it to my own the relative of a director. Now, who is a relative? This is a very open question because relatives, Rimaji, are defined differently in different places. Now, who is a relative as far as Companies Act is concerned? Relatives are very beautifully defined as Aju Baju, Aage Piche, just upar, just niche. Aju Baju is husband and wife. Aage Piche is brother and sister. Just upar, just niche. That means father and mother, son and daughter. If you use this logic in income tax, the same thing, Aju Baju, Aage Piche, upar niche. That means Aju Baju, husband and wife, Aage Piche, brother and sister, lineally ascendant and lineally descendant. Now, if you make a comparison between the relatives of Companies Act and relatives of Income Tax Act, you will find that in Companies Act, grandfather and grandchildren are not relatives. To substitute grandchildren and grandfathers or grandparents, in Companies Act, they have brought in two more relatives, which is son's wife and daughter's husband. So in Companies Act, they have brought in son-in-law and daughter-in-law as a relative. So according to Companies Act, I can give loans to the grandfather and grandchildren of a director, but I cannot give loans to the son-in-law or daughter-in-law of the director. Now, to put it the other way around, in section 40A2B, if I am giving remuneration to my grandfather or grandson, it has to be reported. But if I am giving remuneration to my son-in-law or daughter-in-law, I don't have to report. You know, that is the interplay, how you'll have to look into relatives. Now, let's go further. Any firm in which any such director or relative is a partner. Simple. It could be my wife is a relative in a firm, I am the director, so I cannot give it to either that firm where my wife is a director or any of my relative is a direct partner, or in which I am a partner myself. So these are the things which are banned. However, can it then be given to a director at all? Can it not be given to a director at all? They have brought in fact, let me tell you, two exceptions. Let me straight away go to the exceptions here. Exceptions to section 185, any loan to a managing director or a whole-time director, not being an independent director and non-executive director, you cannot give. Managing director and a whole-time director who is an employee of the company can be given a loan, provided it is part of the service condition extended to all the employees. All the employees have been all the employees are given, and he's also an employee, and if that employee term says up to 1 year, you can take a loan, or for a housing loan, we give you 50% of the house value as a loan and you have to repay it accordingly to all the employees, then for such MD and whole-time director, you can give, or pursuant to any scheme approved by the special resolution. So this is one way out. If a special resolution is passed, a managing director or a whole-time director can still take a loan from the company. And there is another exception. A company which in the ordinary course of its business provides loans or gives guarantees or securities for due repayment of any loan, and in respect of such loan, interest is charged at more than RBI bank rate, then it can give the loans to such a, maybe for an NBFC or things like that. That ordinary course means it should be, lending should be its ordinary course of business. Otherwise, directors are banned. Let us be very clear. Next, corporates. To corporates, such loans, guarantees or securities, I use the word LGS, loans, guarantees or securities, may be given to any person in whom any director is interested only after passing a special resolution, and loans are utilized by the borrowing company for its principal business activity. Now, who is this any person in whom any director is interested? They have defined a private company in which such director is a director or a member, a body corporate at a general meeting of which more than 25% of the voting power may be exercised. They have given certain rules. So to a company, I can give subject to passing of the special resolution, and such a company in turn, using it for its principal place of business. The next point to be noted is Section 185 also gives certain exceptions. A special resolution will still not be required. A special resolution will still not be required. I mean, to such companies, I can give by passing a special resolution, but the special resolution will still not be required to any loan made by the holding company to its wholly owned subsidiary, or any guarantee or security provided by the holding company in respect of any loan made to a wholly owned subsidiary, or any guarantee given or security provided by the holding company to its subsidiary company in respect of loan made by any bank or financial institution. You look at this. First, in the first instance, to a wholly owned subsidiary, one point to be noted is that wholly owned subsidiary and me, the director should be common. If the directors are not common, then there is no problem. 185 does not come into picture at all. If the directors are common and to a wholly owned subsidiary, I can give a loan without passing a special resolution. Then the second thing is, or I can also give a guarantee or a security for the loan given by anybody else. I can give a guarantee. In the second B bit, you will see not a wholly owned subsidiary, but a normal subsidiary. I'm holding only 52%. Can I give a loan to them? The answer is no. I cannot give a loan to them under this blanket. I can go earlier and pass a special resolution and give it to them. But without passing a special resolution, I can give a guarantee or a security. I can give it to my subsidiary in respect of a loan made by any bank or financial institution, provided that loans under A and B above are utilized by the subsidiary for its principal business activity. The loans taken from the bank should not again be used for giving it to the directors or somebody else. It should be used for its principal business activity. Then special resolution is not required. A company which in the ordinary course by charging interest can give loan anyway. That's what I told you earlier. There are penalties and liberalized provisions have come into picture. Are there any exceptions to private limited companies? Are there any exceptions to private limited companies? Here there is this notification dated 5th June 2015 says that in a private limited company, loans can be given to directors. Loans can be given to directors subject to compliance of all the following conditions. None of my shareholders, equity and preference, is a body corporate. In the company, there are no body corporate investors, shareholders. No default in repayment of borrowing at the time of transaction. There is no default from the borrowers. I mean, I have not defaulted in repayment of any of my loans. Actual borrowings from banks, financial institutions and body corporates is less than 50 crore rupees and is less than 2 times the paid up capital. They have given this ratio. If you are borrowing from banks, financial institutions and body corporate divided by paid up capital is less than 2, or and your total borrowings is anyway less than 50 crores. Any one of them breaching, you cannot get the benefit of this exception notification. Please be very careful. Whenever you are saying that don't give loans to directors, no problem. But when I'm advising the company to give loans to directors, if they come to me and say, can a loan be given to a director? either by using this exemption notification or by using that other exception provided in section 185 itself, if I'm saying no problem, you can give the loan, be aware of income tax impact. When a loan is given by a company to its shareholder who is holding more than 10%, or in a firm or entity in which he is holding substantial interest defined as more than 20%, there can be a deemed dividend implication under section 222E of the Income Tax Act. So please be aware of that. So let's move to 186. What does 186 say? 186 goes on to say, again, 185 restricts loans from being given to directors. 186 puts a restriction on the limit up to which a company can give loans or guarantees or securities and make investments. In 185, investments are not covered, but in 186, investments, that is investment in shares, are also covered, for which they have told a limit. What is the limit? Up to that limit, the directors can deal with it. Beyond that limit, there are certain conditions. They say you shall take a special resolution. What is the limit? Beyond 60% of the paid up capital plus free reserves. Paid up capital plus free reserves. What is the meaning of free reserves? Very shockingly, it will be very shocking. What is the meaning of free reserve? Does it include revaluation reserve? Ramesh Kumarji? Definitely no. Does it include accumulated profits?
Yes.
Rimaji, you agree? I also see a senior member, Shiva Raman, sir. So nice of you, sir. Such a senior member, so eagerly listening, and honor to me, sir. Sir, what is your view, sir? You can just unmute if it is possible. Otherwise, okay, I will just, you can.
Not possible to unmute.
Does accumulated profits also be included in free reserves? So, I mean, Ramesh Kumarji and Rima say that it is yes, but surprisingly, the answer is no. Surprisingly, the answer is no. Why? Because I told you in the beginning when I talked about section 123, there is profits, there is accumulated profits, and there is reserves. Then there is reserves. And I also told you reserves and surplus are two different things. We just use reserves and surplus as one word in accounting, reserves and surplus bolke. But that is why they are saying reserves and surplus. It is like husband and wife. You know, they are two different things. So reserves and surplus are two different things. Their word used here is free reserves, and free reserves does not include surplus, does not include accumulated profits when you are calculating this limit. So beyond 60% of paid up capital plus free reserves, or 100% of free reserves, whichever is higher. So that is the limit that they are told. If you are breaching this limit, breach of the limit to be checked for aggregate amount. That means existing loan also should be taken into account. Special resolutions specify the total amount up to which the board of directors is authorized. Unanimous consent of all the board of directors present in the board meeting is required. Any one of them objecting, it will fail. That you cannot give the loan or invest more than this particular limit. One very interesting thing is 186 says, what is the wording used? Any loan to which the provisions of this section applies, you shall charge interest. You shall charge interest. Now the debate is, should the company charge interest on every loan or only on such loans to which the breach has happened? I have opined, in my opinion, it is applicable only to those loans to which the up to 60% or up to 100%, whatever that limit, then there is no compulsion that the company shall charge interest. If the company does not charge interest on the loans given, especially to related parties, I will have to comment whether it is prejudicial to the interest of the company. Even if I am paying interest and I'm not charging interest when I'm giving it to my directors or key related parties, then I will have to comment that it is prejudicial to the interest of the company. But the point is here, 186 compels me to charge interest on such loans to which the provisions of this section applies. So I have opined that the provision of this section applies only when it breaches that particular limit. And you can give this loan only if there is no default in public deposits, a repayment of public deposits, or PFI is considered as public financial institutions dues. Okay? This provision is not applicable to banks, housing finance companies, infrastructure companies, NBFCs, and shares allotted to under section 62(1)(a), that is rights issue shares. Very interesting. Now, having said that, I mean, we've talked about Schedule 6, Schedule 6 of 1956 Act. You know what Schedule 6 of 2013 Act deals with? 2013 Act deals with Schedule 6 on a very small topic, definition of infrastructure companies. I mean, that is why I bought, infrastructure companies are exempt from 185. And where is this infrastructure defined means Schedule 6 of the Companies Act 2013. So disclose in financial statements any loan given under this particular section that is beyond that particular limit. Otherwise, there are penalties. Does 186 apply to 185 companies? Does this limit apply to 185 companies? The answer is yes. Now, for this session today, yesterday I sat and made this particular chart for easier understanding as to what is the fundamental difference between 185 and 186. 185, restriction on loans, guarantees, and securities, that is LGS, to directors, etc. In fact, the heading of the section is etc. And the entire thing is to understand what is this etc. When directors, we know, etc. means, I told you, partner of a firm in which the director is interested. So that understanding of that etc. becomes the crux in 185. Restricts LGS to directors and etc. subject to certain exceptions, which we have already seen. Managing director, whole-time director can be given, or especially if it is through a special resolution scheme, if it is given to all employees, or if you are coming under that particular green private limited companies, or for corporates, special resolution and things like that. Restriction does not apply to grant of loans, guarantees, and securities to any entity if the directors are not interested. Now, please understand, LGS is not, say 185 does not come into picture if loans are not given to directors, whereas 186 will come into picture even if the loans are not given. 186 applies both to directors and others. Point number 3, restriction may not apply to subsidiary and wholly owned subsidiary unless directors are interested. I mean, for that matter, any company, including subsidiary and wholly owned subsidiary, only if the directors are connected or common, I mean, they have told certain restrictions, then it will apply. Where directors are interested, special resolution is not required if and only if they use in their principal business activity. Such loan taking party uses it in the principal business activity. In case of LGS provided to wholly owned subsidiary, guarantees and securities provided for loans availed by subsidiaries from a bank financial institution. Next, 186(2) is restriction on limits, whereas that is restriction on loan. Here, restriction on limits on giving of loans, guarantees, securities, and making investments. So here states a limit up to which it can be given. Beyond this limit can be given subject to certain conditions. Limits also covers investments, whereas in 185 investments are not considered. Limit applicable to all LGS SI, including LGS covered by section 185 and those exempt under section. Even if they are exempt under 185, they get covered under 186 for the purpose of arriving at the limits. Shall we move to the next aspect, which is deposits? Now, let me give you an overview of deposits. Most dangerous section in the Companies Act is deposits, because the highest amount of penalty can be as high as 2 crores for breach of section 73 to 76. So let us be very clear. So therefore, this section is the most dangerous section. Although I am not getting into the detail in that sense. Last year I spoke at the SIRC somewhere in the month of August or so. The recorded portion is there. It has not changed. So 3 hours I've spoken only on deposits and related party transactions. So please, those of you who are interested in getting to know the details can look into that. But here I am, for the purpose of understanding CARO, what is required for an auditor is what I'm going to tell now. So what is the question in CARO? In respect of deposits accepted by the company, what has been struck off? Case the company has accepted deposits. This is there in 2016, but in 2020 they have struck off and introduced some new words brought in red underlined version is from 2020. Otherwise, the sum and substance remain the same. So I'm not getting into the details of that. In respect of I will go for 2016 version. In respect of deposits accepted by the company, amounts which are deemed to be deposits, whether the directors issued by Reserve Bank of India and provisions of 73 to 76 or any other relevant provisions of the Companies Act and the rules framed thereunder, where applicable, have been complied with. If not, the nature of the contravention should be stated. If an order has been passed by Company Law Board or NCLT or RBI or any court or any other tribunal, whether the same has been complied with or not. One thing we have to understand is acceptance of deposit rules and all these sections are not applicable to a banking company, NBFC and HFC. Such other company as the central government and Reserve Bank of India may specify. So let's see what is this section 72 to, in fact, it starts with the 72, 73, 74, 73, 74, 75, 76. So 4 sections. It goes to capture any money received by the company will become a deposit. Any money received by a company will become a deposit unless it falls into a Rule 2(1)(c) exception, which is told as not deposit. So we will see what those not deposits are. Otherwise, everything will be a deposit. Let us be very clear. So we will see this particular about 18 items have been told to be not deposits. These, apart from these 18 items, everything else will become a deposit. If it is money received, if it is goods received or any material received, then section 73, 74, 75, 76 does not apply. Let us be very clear. Somebody was telling creditors, if it is outstanding for more than 1 year, will become deposit. The answer is no, because creditors are not taken in goods. I mean, is not taken in the form of money. That is goods taken for which money has to be paid. MSME Act may apply to that. Within 45 days you have to pay. But deposit rules will not apply to them. Any money received by the company, unless it is exempt under 2(1)(c), will become deposits. Let us immediately see what are the exceptions available. Then we'll go back to that. So what are these exceptions available? Money received and not deposits. This becomes very important because every company today has to file DPT 3 for all the money received, whether it is a deposit or it is an exempted deposit. A DPT 3 has to be filed by the company every year. So that's the point. So we need to know what the exempted deposits are. Any money taken. So deposit includes any receipt of money by way of deposit or loan or in any other form by a company, but does not include any amount received from 1 to 18 items. If the company has received from central government, state government, local authority, any foreign entity subject to FEMA. If it is cleared by FEMA, it is cleared by Companies Act. Any loan or facility taken from a bank is an exempted deposit. Loan or facility taken from public financial institution, any commercial paper, any money taken by another company. So I told you this section is to protect a gullible investor from giving money to a company thinking that company is big. Now, another company cannot be a gullible investor. So they said, if one company is giving to you, then he need not be protected because he knows what a company is. So one company can give loan to another company subject to 185, 186. That company has to look into 185 and 186. I don't have to look into 73 to 76 because it is an intercorporate deposit. Don't be misguided by the word intercorporate deposit, because corporate includes LLPs. But if an LLP is giving money to a company, it will not be covered because the word used is any other company only. Security application money within 60 days. That means any money received towards the share capital must be allotted within 60 days. You cannot keep it as share application money. Share application money from the 61st day up to 60 days, it will be an exempted deposit. From the 61 day, if it is not allotted, within 15 days window, you have to return it. Otherwise, ab initio, it becomes a deposit. And an auditor has to qualify that in CARO. Any money received from the directors when they were directors of the company is considered to be an exempted deposit. Any money received from the relatives of such directors, are also, relatives only for private limited companies. In a public limited companies, relatives of directors cannot give. Only in a private limited company, relatives of directors can give. Subject to both directors and relatives can give money to the company by giving a declaration. What is a declaration? They should say that this money received is not out of borrowed funds. That is out of their own funds. Then compulsorily convertible debentures. and any secured or convertible debentures or unsecured listed non-convertible debentures. They can also be exempt. Any money received from an employee up to 12 months salary, up to 1 year salary is exempted deposit. Any amount received as non-interest bearing amount and held in trust. I mean, I was just trying to understand what is the reason. Normally, the gullible investors, if you say, I am not going to pay you interest at the time of telling itself, then he will not invest. So therefore, such a person need not be protected. When I have told him, Abhinisha, that no interest will be given, but I will keep it under trust with me. So such a amount is also not considered. So there is a one way out. If the company wants to bring in this amount, this route is available. Unsecured loans from promoters, if and only if stipulated by the banks. If and only if stipulated by the banks. That means when the bank is giving me loan, if they insist that the promoters have to bring in a 25% margin, that amount brought in, although they are not directors, but just by being promoters, they can bring in. But there is one condition. This will not be considered as deposit only till such time the bank loan subsists. The moment you repay your bank loan, this window of item number 13 will go away. Any amount accepted by a Nidhi company, any amount received in the course of or for the purpose of the business of the company as advance from customers. You can receive advance from customers not more than 365 days. If any advance from customer is received by a company beyond 365 days, it will become a deposit, contravening the provisions. Then you will have to comply with the provisions. Otherwise, it will go to I'll tell you, I call these as green deposits because this is all in the green zone. Then if you are accepting deposits by complying with the conditions, then it becomes a blue deposit. So you can take a green deposit or a blue deposit, failing which it becomes a red deposit. A red deposit means a penalty of 2 crores, mind you. So advance for immobile property can be taken. Money can be taken towards sale of immobile property, and it need not, the 365 days restriction is not there. Security deposits under contract, advance for long-term projects, advance for future services, sectoral regulator, subscription towards publication, chit fund subscriptions, collective investments, and 17th, why I put it in yellow is there was an amendment last year on 7th September, up to 25 lakhs, when more than 25 lakhs in single tranche, amount received by a startup as convertible note, convertible to equity shares or repayable within, initially it was told as 5 years, then they made it 10 years on 7th September. By a startup, there are a lot of relaxation. This is one other relaxation. Alternative investment funds. So I will not get into the details of this. All I'm saying is money received can be either an exempted deposit under Rule 21C, 18 exempted deposits by private limited companies, public limited companies, or it could be deposits. I told you blue deposits, by virtue of which you will have to comply with lot of rules. So what is that rules? It can be either, deposits can be either taken from members, that is shareholders, or from other than shareholders. If you are taking from other than shareholders, that is non-members, you have to comply with lot of conditions. I'm not talking about that at all today. That can be taken only by eligible public companies, companies with a net worth of more than 500 crores and all those stuff. Section 76, let us not talk about that in a session like this. If it is from members, it can be either by a public limited company or a private limited company. For a public limited company, up to 35% of the net worth, they can take it, subject to compliance of certain deposit rules. Whereas in the case of a private limited company, they can take up to 100% of net worth. Again, they have to comply with certain rules, but exception provided to item number 5 to 9 in the next slide. You know, they have to comply with a lot of requirements. There have been provided certain exceptions. Now, if up to 100% of the net worth, if my net worth is actually 1 crore, I can go up to 1 crore taking money from the shareholders. From directors, I can take any money. From relatives of directors, I can take any amount. But from the shareholders, not being directors, not being relatives of directors, I can take up to 100% of my net worth. Or if it is a startup, such a startup can take any amount by an eligible startup up to 10 years from the date of its incorporation. And a private limited company, specific clause they have told, In the case of such a private limited company, which is not an associate or a subsidiary of some other company, where the borrowings from banks and financial institutions divided by paid up capital is less than 2 or less than 50 crores, or no default in repayment of such borrowing is done, such a private limited company can take loans, can take money from shareholders, any amount if these three conditions are complied with. So coming back, I'm just put it the gist of the requirement. In a public limited company, if it is only for members, non-members I'm not touching today, that is from shareholders. In the case of a public company, up to 35% of the net worth they can take. In a private limited company, up to 100% of the net worth they can take. But for private companies, maximum limit, that is 100%, is not applicable if and only if all the conditions are complied with, and there is a subject to no default in filing annual return and financial statement. For a startup company, startup private limited company, which is approved by the DPIIT, for the first 10 years as per notification dated 7th September 2020, other than above, if and only if all the conditions fulfilled, we have already seen that. Now, in this case, what are the conditions that they have to comply with? Action point 1 to 4 is by every company, including a private limited company. 5 to 9, a private limited company is exempt as per 13th June notification. So what are let us see what are the action points. File DPT3, I already told, before 30th June. But for taking money from the members, they have to take a application form, and the application form should be submitted by the intending depositor, and a declaration should be given by such a member that it is not out of borrowed funds, and it should be after passing of resolution in a general meeting. I can take money from the shareholders in the form of deposits by passing a resolution in the general meeting. The following 5 to 9 conditions are not applicable to private limited companies. I may be allowed to skip. Okay. I just talked about preferential allotment or private placement. Okay. Here I would like to show in one slide and proceed further. I will not get into the details of this. A public company can issue shares using either a public issue or private placement, rights issue, ESOP, and preferential offer. Whereas a public issue can be either in the form of initial public offer, follow-on public offer, or offer for sale. This can apply only to public limited companies. For a private limited company, cannot go in for a public issue. Very simple. A private company, including a public company, can take money either by private placement, a rights issue, ESOP, or preferential offer. ESOP is very simple to understand. That means shares allotted to employees by taking money at a discounted price, subject to they being continuing with the company for the period agreed in the offer. ESOP is clear. No money, no issues there. They have to comply with 62(1)(b) conditions. That is anyway not asked in the question. What is asked in our CARO is preferential allotment or private placement. Next, whenever a company allots the shares, additional shares for that matter, it has to first go through rights issue. That means the existing shareholders only should be given the right of first refusal. That is called rights issue. If they take it, there is no problem. There is no question of private placement or preferential offer. Now, what is, if they say, I don't want it, give it to outsiders, means it has to go either through section 42 route or section 62(1)(c) route. That means it can be either a private placement or a preferential offer. So what is a private placement? If I am allotting shares other than to my existing shareholders by name, I identify, there are A, B, C, D shareholders existing. A, B, C, D shareholder says, I don't want the shares. You give it to an outsider X, Y, Z. If X, Y, Z is given by name, then it becomes a private placement. In the case of a preferential offer, the shares allotted to other than the existing shareholders, not being named, that becomes a preferential offer. So a preferential offer in both private placement and preferential offer, I do not actually give it to the existing shareholders. That can happen only by virtue of passing a special resolution. Both private placement and preferential offer can happen only if the existing shareholders, by passing a special resolution, say that we don't need it or we don't have the ability to pay, let us give it to an outsider. And that outsider, if he is named, it is a private placement. If he is not named, it becomes a preferential offer. There are a lot of conditions for that. I am not taking those conditions today. Next, related party transactions. Now I have to be quite fast here because in the next 25 minutes I have to close. Whether all transactions with related parties are in compliance with section 177 and 188 of the Companies Act 2013 and where applicable, and the details have been disclosed in the financial statement, etc., as required by the applicable accounting standards. Now, what is the meaning of etc. here? Financial statements is what I'm going to comment upon. Details have been disclosed in the financial statements, etc. Etc. here means board report. In board report also, the disclosures with respect to related parties have to come in. So those are the things, and maybe when there is a proper related party resolutions passed, disclosure in the notices whether they have been properly made. Those are the things also which one has to look into. Now, if you look into the Companies Act, there are various chapters. Chapter 12 deals with meetings of board and its powers. I always keep telling this on a jocular way. Chapter 9 deals with accounts. Chapter 10 deals with auditors. Chapter 11 deals with directors. Accounts are very important. Accounts are very important. Therefore, accounts is chapter 9. But chapter 10, before dealing with the directors, Companies Act deals with auditors. Chapter 10, auditors is more, auditors are coming before directors in Companies Act. That means more vigilance have to be done by the direct auditors more than the directors is what it is conveying the message. And I always keep telling, maybe the chartered accountants have taken, we wanted the t-shirt 10 on our, for playing. Normally 10 means 10 Dulkar, all these Messi and all those people, they have the 10 on their back t-shirts. So maybe chapter 10 means we have to be proud that, we have been given the 10th jersey in that sense. Having said that, 11 is actually dealing with directors. 12 is dealing with the meetings of directors and its powers. A very elaborate chapter dealing from section 175 to 195, 173 to 195. If you see, this is a very powerful chapter because the entire Companies Act is managed by the directors through their board meetings. So therefore, so many sections are there. So at least we have to be aware in our audit report, at least how many sections? 177, 188, 186, 188, 192. So many sections have been asked to be commented upon in CARO by the auditor. So that's the highlight of this particular section. We now move to related party transactions. Now, companies entering into contracts or arrangements with related party, all companies including private limited companies, I already told you this, are they entering into transactions with related party? We have to find out who the related party is. First of all, we have to find out who the related party is. There are about 9 types of related parties. The 9 types of related parties. If they are related parties, then this kicks in. If they are not related party, it does not kick in. We will see a related parties who they are. Then we'll have to see if they are related parties. I'll see whether it is done in the ordinary course of business and at arm's length. If it is done at ordinary course of business and arm's length, no action required. If it is not done in the ordinary course of business, or if it is done in the ordinary course of business but not at arm's length, or any one of them breaching, I will then go to whether the related party transactions are stipulated. There are 7 types of stipulated related party transactions. If they are not in the related party transactions listed out here, for example, directors' remuneration paid to managing directors are not covered in 188 because they are covered in 197. Loans given to directors are not covered here because they are covered under 185. So like that, they have we have to see those 7 type of transactions whether they are stipulated. If they are not of the 7 type of stipulated transaction, 188 does not come into picture. If they are one of the 7 types, then I have to see whether the limits have got breached. If the limits are within the limit prescribed, then just take a board consent. The director's approval through a board meeting is sufficient. If the limits are breached, then apart from the board consent, I also have to take a prior ordinary resolution. And when I pass a prior ordinary resolution, there are elaborate disclosures in the notice of board meeting and explanatory statement of general meeting. That is what is that, etc. Etc. I told you, auditor has to look into not only the financial statement disclosures, but disclosures in the board meetings, explanatory statement of general meeting. Directors report. Interested directors are members not to vote at the board meeting or ordinary resolution, not applicable to private limited companies and to others, subject to 90% rule. I mean, that is another exceptions, who can participate in the meeting. Default, if there is a default in the compliance of 188, the entire transaction can be voidable at the board's option. They can say that we don't want to enter, please give me back our money. So that is how it is. If the company has an audit committee, then audit committee to approve all transactions before the board approves it. That is what is told. Audit committee where it is required. Audit committee can give omnibus report, and this related party transaction will not be applicable to holding subsidiary, associate and financial and fellow subsidiaries, not to be treated as related party transactions in case of private limited companies. So this is to be understood. So what are the things we have to understand further here? What is the meaning of a related party? What is a related party transaction and what are the limits? These three things we have to understand. So who is a related party? So as I told you that related party, they have defined 9 types of related party. Director or his relative. When I have put 2 on the right side, because the director could be a related party or the relative of a director could be a related party. Key managerial personnel or his relative. That means the key managerial person, of course, there could be various types of key managerial person, but key managerial person as a group could be one type of related party or the relative of the key managerial person. Next, I'll go fast. Firm in which the director, manager or his relative is a director. Private company in which director or a manager or his relative is a member or a director. Public company in which director, manager is a director and holds more than 2%. So like that, they have given certain things which you'll have to look into. I'm not getting into the details. So there are 9 types of related parties, and which can actually become 31 types considering the varieties there. Relative, key managerial personnel. Now let's go to what are the 7 types of related party transactions and what are the limits that they have prescribed. The 7 types of related party transactions I have listed, and accordingly I will finish off the limits also. If it is sale, purchase, supply of goods or material, 10% of the turnover. Originally, it was also said or rupees 100 crores, whichever is lower. They removed in the Companies Amendment Act, they said they removed or 100 crores because for, let us say, a very big company like L&T, Reliance and all, or 100 crores means there could be a lot of transactions with their associates which will breach 100 crores immediately. So they said only 10% of the turnover is the criteria now. Selling, disposing, buying or property of any kind, 10% of the net worth. Leasing of the property of any kind, 10% of the total turnover. Availing or rendering of services, 10% of the turnover. Appointment of agent for purchase or sale of goods or material, services or property. I mean, this you appoint agent either to buy or sell material, goods or services. Then those respective limits will apply. Appointment to any office or place of profit in the company, subsidiary and associates. Either you are, see, one thing we have to understand, what is this office or place of profit? It is not the same as remuneration. If a director is also working as a consultant, he is also taking some professional charges from the company, not being director's remuneration, then that is considered as a place of profit. And that place of profit could be not only the director, but the related party of the director. Then in such cases, if it breaches 2.5 lakhs monthly remuneration, ordinary resolution is required. So underwriting subscription of securities or derivatives, remuneration more than 1% of the net worth. So these are the things which we'll have to note into. What is our guidance note talking about? If the auditor comes across any non-compliance or difference in opinion, then it should be reported in the following format. They have given the format for reporting. Now, next 15 minutes, I will quickly wrap up. I know there may be some questions, so I may have to breach the time for the sake of questions, but my presentation I will finish off in the next 10-15 minutes. ICAI announcements on accounting and auditing. Communication with the retiring auditor can be now through the email, but what you'll have to understand is that email should be the official email. I cannot write to whatever email I have. It should be the latest known official email address or that which is registered with the ICAI. And they say, if it is through an email, I should get an acknowledgement from the other side. if it is through a post, it can go through a registered post acknowledgement due, and the acknowledgement due certificate is sufficient even if the other person, if other chartered accountant does not reply. Although it is a good practice for the other chartered accountant to reply, but I can start my audit even without the retiring partners, retiring auditors reply, as long as I have the acknowledgement. Now here, acknowledgement of communication would be deemed as valid evidence of positive delivery of communication. Now, feedback of credit rating agency about auditee client. We have seen that a lot of credit rating agencies directly approaching us and asking our opinion about the client. We are asked to desist from giving such a opinion on the client unless permitted by the client. That's a point to be noted. CAS from 13th April 2020 may use DSCs for signing audit reports and certificates. Of course, they have told ensure other required compliances and obtain UDIN. Now, UDIN, when we are talking about, please, I mean, I'm sure all of us know, but let us also reiterate this point that non-generation of UDIN may lead to disciplinary proceedings. Maximum window available to you is 15 days from the date of signing. And anyway, the backdating is not possible at all now. 31st March 2021 was the last date for condonation. So please note this. CBDT has now made it very clear for all the tax forms that we are signing off. The UDIN generated must again be revalidated in the e-filing portal. And now the last date for, in case you have missed out any validation, up to 30th June, you can go and revalidate. Otherwise, that form which you have filed for income tax will not be considered as filed at all. So that is it will be considered not as defective. It is deemed never to have been filed if you don't revalidate the UDIN in the e-filing portal. And ICAI, last week they sent a note to all the members saying that has been given to understand that CBDT is in the process of mandating updation of UDINs for all IT forms prior to its getting uploaded on the e-filing portal. So if that comes, so it has to be online. So even that 15 days window may not be available. So there are certain advisories issued by Accounting Standards Board and Auditing and Assurance Standards Board from our institute, which we need to be aware of. They have told about, because of COVID, we may not be able to go to the client's place. We may not be able to visit them for audit watching. Our boys may not be able to go even for physical counting of the stock statements. So they have given us advisory as to how to deal with such a situation. Because of COVID, there could be certain going concern issues with respect to the companies. So a separate talk can be arranged by the branch here. So there are 1, 2, 3, 4, 5, 6, 7 or 8 advisories have been given. Important amongst them is the going concern key consideration, physical inventory verification if you are not able to visit, and auditors reporting key audit considerations, subsequent events. One thing we have to notice, although COVID will have sort of a restriction on our going to the client's place, going to the physical verification of inventory, etc., there will be no relaxation in the standards. We have to comply with all the requirements. And tomorrow, if there is any disciplinary proceeding, you will have to be meeting it. You can say that all of us did not do that. But if the notice comes to you, you will have to deal with that all by yourself. Now, other aspects affecting accounts and audit, MSME reclassification has happened. So please tell your clients that trade payables, what we show in the balance sheet like this, trade payables, total outstanding dues of MSMEs, like last year, if you continue with the same classification, it is wrong. So please talk to all the suppliers and find out whether in the revised scenario, they have become now MSMEs. So revised, considering that, the number of, the value of reporting under MSMEs could go up. So please have that as a watch point. The Reserve Bank of India has given moratorium and a deferment of interest payables and things like that. So that would lead to, when you're doing the audit, classification of current liabilities, non-current liabilities could undergo a change. There could be requirement for you to do a impairment testing. We have seen some of our clients who have invested heavily in the furnitures, and now that the furniture will never be used at all, will never be, because of the work from home, especially technology sectors, they are all working from home, and in the next 3 years we would have otherwise depreciated in the next 3 years. Now that the entire setup is going to be a waste, the employees may never go to that place at all. This entire investment done in the furniture and fixtures will have to be impaired in 1 year. Then provisioning for income tax, there will be some disallowance under 43B because of the interest not being paid and things like that, then impact on reporting of CARO 16 on default. When if it is only a deferment, it is not considered as a default in that particular sense. Now, this is one slide where we can discuss that every accounting standard will have a implication. Disclosure of accounting policies. So on accounting standard 1, please be aware of going concern. Going concern can be an issue in the current situation. Valuation of inventories, net realizable value. Especially we have seen last year that a lot of items which were there on 31st of March 2020, because of the lockdown, it had to be actually thrown into the gutter. On 31st of March, it had a value. Subsequently, we had to throw it into the gutter, especially the alcohol, spirits, and things like that. So how do you value such a thing on 31st of March? Will you value it at 0, or will you value, should you consider subsequent events? The answer is subsequent events have to be considered when you are doing the valuation on 31st of March. How do you allocate the fixed overheads becomes an issue. Cash flow statement, of course, collateral damage. Contingencies and events occurring after the balance sheet date. As I told you, we'll have to consider events occurring after the balance sheet date to talk about in the to arrive at the value in the financial statement. There could be a lot of extraordinary items and exceptional items that could come out on the face of the financial statements. There could be a lot of disclosures. Revenue recognitions will have to be postponed when considering the COVID situations. If somebody has promised to take and he has never taken, then how do you deal with that situation? Depreciation during lockdown has to be there. I mean, there could be a lockdown, the assets may not be used. In spite of that, there could be an argument saying that the useful life of the asset has gone up because it has not been used to that extent. So if it is based on time basis, it has to be depreciated. If it is only on unit of production basis, then one can consider that aspect. Now, review and change the expected life and residual life, impairment possibilities. Forex losses due to rupee weakening could be one of the issues. Provident fund contribution by the government. Last year, government has contributed provident fund. How do I treat it? Should I treat it as a government grant, or should I not debit it to my profit and loss account itself? Could be, there are two ways. In my opinion, it should be taken as a government grant and shown as a expenditure. That is how it should be dealt with. Accounting for investments, there could be decline in the value of long-term investments, which one have to provide for. Employees benefits. A lot of employees could have retired, left, and things like that, which could have an impact on the actuarial valuation. Borrowing costs. I mean, now we have seen that a lot of construction activities would be suspended. Now, should we carry on with the interest capitalization as told in accounting standard 16? My answer is no, because this particular lockdown, if let us say for a month's time, the construction has got suspended, the interest capitalization because of this suspension must not be capitalized, rather it should be debited to profit and loss account. Although income tax ICDS will say continue suspension, continue capitalization till the asset is put to use. Accounting standard 16 is very clear. If it is not for a normal reason, then it has to be suspended. Of course, one may say that this is abnormal and continue, but that could be a matter of opinion altogether. But in my opinion, it should stop capitalization, because this particular capitalization will not add any value to the asset in that particular sense. Accounting for taxes on income, discontinuing operation, interim financial statements, provisions, contingent liabilities, all of this will have a impact in that particular sense. So COVID financial reporting and audit, areas of concern, audit documentation, audit evidence, gathering audit evidence, especially if I have to sign sitting in my home and all the documents are there, we are not able to take the printouts, but if there is a pressure that it has to be signed off, then it could be a very difficult task. But you cannot, although the situation is tough, you cannot relax on any of the requirements. As I told you, once you sign, you own up that particular signature. So external confirmation must be obtained, and if something comes by mail, please identify that the person who is sending is actually the right person, rather than somebody sending and you taking it as though it is right. Using the work performed by others, we may have to sometimes, suppose the place is let us say I have a client in Trivandrum and I'm not able to visit Trivandrum. I may request Mr. Ramesh Kumar to do the audit or watching or physical verification on my behalf, but I will have to take all the aspects into account before I sign off. Although he has done, I will also be equally responsible with him. Maybe he's also responsible and I will also be responsible. I'll have to consider that. Then COVID-19 challenges, implications on the audit report. There could be new key audit matters which has to be reported on account of the outbreak. Material uncertainty in relation to going concern paragraph, which we discussed. Emphasis of matter, there could be significant uncertainty arising from the outbreak, whether we have to report this. Qualification or adverse report, of course, we'll have to consider. And IFC, there could be additional risk areas, especially the risk areas in internal financial controls could be work from home related, technology related, controls related, all these, especially the IT enabled control related issues could be there. So all these things have to be considered before we get into this. I wish I could have discussed this particular notice, how the notice can come to a chartered accountant. Recently, one of the chartered accountant received a notice which is about containing 20 or 22 points on the chartered accountant. Like questions like how the company contacted you. That means, what our institute keeps telling, you should have a KYC, know your customer, know your client before you do the audit. Do any of the partners of your firm know any of the directors or shareholders of the company? The answer to this, how will you say? If I say I don't know, then how did you do the audit? If I say I know, then why did you do the audit? Because if you know, probably the right way to say is, I know them in the official capacity. None of them are related to me in any other way. That would be the basis. Have you done any background verification of the directors before accepting the assignment? Now look at this. There is a expectation that the auditor means he has done an audit on not only their financial statements, but audit of their house and their relatives. That's how they're expecting. That's what I call the expectation gap. Directors have given a statement that you are only managing the books of accounts of the company. Is it true? In that case, your firm is doing audit of the company and also managing the books of accounts of the company. It is against section 144 of the Companies Act. Kindly provide your explanation in this regard. Now, some of the chartered accountants, if they're doing so, they will think that how will I know, how will the company, how will the audit, anybody know that I am writing the books of accounts? Maybe please understand that whenever such notice comes, there are certain directors who are not happy with the other directors. So when there is a fight between two directors or two groups of directors, the auditor will be the collateral damage. So one group of auditors will say that he's only writing the accounts and he's only auditing. Therefore, what he does is not right. So this could be the issues. Submit all audit working papers. This is what the regulator is asking. Provide detailed working for revenue recognized. What kind of audit procedures you have conducted to assure that revenue recognized is true and fair. Balance confirmation you have obtained from, provide balance confirmation you have obtained. Explain how you have certified that the closing inventory amounting to rupees so and so. Verify that all related party transactions are at arm's length. But for construction like that, there could be various types of questions which could lead you to become very embarrassment. So please understand that what we are doing is always questionable. We are not the ultimate. There could be various regulators like our institute, like the NAFRA. So we have to take all these things into account. Now, before I close and take up the questions, I can stop by saying, recently I addressed a Hyderabad branch where the chairman was Pankaj Trivedi. When I told him Trivedi means what? One who is an expert in the three Vedas. One who is expert in the three Vedas. And then I had to tell him that we chartered accountants are also to be three Vedis. And for us, three Vedas are not Samaveda, Atharvaveda, and whatever the Vedas we have. But it should be the compendium of accounting standards, the compendium of standards and auditing, and the code of ethics. So we have to follow these three Vedas and become three Vedis, if not Chaturvedis. If you have to consider Companies Act also, that is another Veda which we'll have to consider. So then you become Chaturvedis. So with that, I end my presentation. It's 1:30. Thank you so much. I am open for questions.
Sir, we have few questions in the chat box.
Yes.
Right now. Is Chief Minister's Relief Fund applicable for CSR?
Chief Minister's, unfortunately, no. Unfortunately, no.
What about?
It is applicable for ATG, but not for CSR.
What about a company which ought to have been registered as NBFC, but not registered?
No, they have to go and register. They have to seek condonation and get it registered. That's the only way out.
Sir, a question is, sir, a company upon finalization of accounts, which was done after the year end, realizes that the profit is just over 5 crores. What to do with the CSR obligation?
Then that year it kicks in. In the immediate preceding previous year, if it is more than 5 years, that year you have to spend. It is not in the same year.
Whether amounts outstanding as sundry debtors in the books of account of the company in the name of directors will be treated as
I'm sorry. Because here it says, I think going back to Ramesh Kumar's question, 5 crores if it has breached 5 crores, then you will have to put it as an ongoing project and spend. That's the only way I would say. Yeah.
Whether amounts outstanding as sundry debtors in the books of account of the company in the name of directors will be treated as loan to director.
Yes, section 185 very clearly says, including book debts.
2015 notification with respect to section 185 exemptions to private company, is this still valid after the amendment of the act?
Yeah, it is still amended. It's still valid.
Where a company has invested in the shares of its subsidiary company, which is an NBFC, and the NBFC, as part of its normal business activity, gives loans to the directors and his relatives, which in turn is used for reducing the balance in the debit balance in sundry debtors account of the parent company. Whether these transactions should be treated as Benami transaction.
No, I mean, see, Benami transactions are one where I have given it to an entity and told it to be given in turn to my own identified persons. Okay, if I have given it to an NBFC, that's what is the question, right? I have given it to NBFC. The NBFC has in turn given it to so many people, not at my dictation. If it is at my dictation that it should be given, then it could become, I would not call it as a straight away Benami. I mean, I would say that I'm using this particular thing for a conduit. I'm using them as a conduit. Normally in such situations, I am not supposed to tell to whom they have to lend it. So if that is the situation, there should be no problem.
Is unpaid audit fee over a year will be deemed as deposit?
I think that is a matter of code of ethics, where they hold that any financial, see, can there be a loan given to a client? Can there be a loan given to a client? The answer, can I take a loan from the client? That is very clearly barred in Companies Act. In Companies Act, I cannot take a 1 rupee loan from my client and I have do his particular audit. But what is told is, can I give a loan to the client and then do the audit? The answer is again no, because I cannot have any business relationship with him, especially if I take interest. Okay. Now the question that came out is, will the outstanding loan be considered as a loan given to the client? Now there our code of ethics has come into picture to say any outstanding of more than 1 year could be considered unless the amount is material to you. I mean, unless the material amount is not material to you or to the client. And that is how they have put it. They have put it as sort of a subjective thing and left it. So that means if that amount is so huge that it is material to me, then the answer is yes, it could be a loan. Or if it is material to the client, then it could also be considered as a loan given to the client. So in short, use this particular thing to get your audit fee. Don't have your audit fee outstanding for more than 1 year.
Whether share capital pending to be collected from promoters can be shown as receivable in the first balance sheet of the company.
That is the only way we can show. It has to be shown like that. Funds can be kept as receivable from the promoters, but now that section 10A is there, where you will have to file within 6 months that all the monies which have been promised has to be received, for which relaxations have been there up to 12 months.
If any of the balance sheet or P&L line items as per Schedule 3 format is nil for a company, should it mandatorily report those heads with nil value for the sake of...
Not required. We have never been showing it. And let me tell you what is the answer. MCA has never told this. Our institute has also not pointed out this as a mistake. Infosys and all those terms, right from the beginning, I was telling this example. Infosys was a zero debt company. In their entire balance sheet, it used to have in the equities and liabilities, they used to have only equity, share capital and reserves and surplus. They never had secured loan, unsecured loans. So they had shown only these two items, and the institute gave them the best presented accounts. Do you understand what I'm saying? So if that was required, they could not have given that as a best presented accounts.
Whether unbilled revenue from parent company to be disclosed as a related party transaction under section 188. Further, whether both P&L and balance sheet items pertaining to the related party is to be reported, that is both sales and sundry debtors balance are to be reported, or sales itself is sufficient.
I understood the first question. Second question, I will again, whether unbilled revenue from the holding company,
parent
company,
yes,
is to be treated as, is to be shown as related party transaction.
Correct.
The point that I'm saying is related party transactions. First, you will have to see whether before you enter into the transaction, you have to comply with the provisions of 188. And having complied with the provisions, if you have complied it, then of course the disclosure will come. Even an unbilled revenue will be a disclosure in the financial statement. So please note that the compliance, there is a compliance and a disclosure. Compliance is take a proper ordinary resolution if it breaches, board resolution if it does not breach, things like that. And of course, if it is at arm's length and ordinary course of business, nothing required, only the disclosure. The disclosure comes both from accounting standard 18 and from the section 188. So one has to disclose the unbilled revenue also. What is the second bit of the question?
Second bit, further, whether both P&L and balance sheet items pertaining to the related party is to be reported. That is the sales as well as the sundry debtors, or just the sales we have to disclose as related party.
See, what happens is, let us say I have sold 10 crores and outstanding is only 50 lakhs. Do I have a choice of showing 10 crores or 50 lakhs? Means no, you have to show both.
Whether audit trail is required only for accounting software or other integrated systems like loan management system, HRMS, procurement systems, etc.
I think the mandate is only for accounting software. So while it will be a good practice to talk about the trail for all those things, but I think the substance is to do about the accounting.
Sir, Alex, sir, question, Ramesh, sir, you have already asked, no? A company is having net profit above 5 crore. That you asked, no, already, Ramesh, sir?
Yes, sir. Yes, I'm asked.
Okay, next one. Money received from state government towards share capital, but shares not allotted within 60 days can be considered as deposit.
Yeah, I think that's a very good question. But first of all, why did we not? It was a big issue. While it could contravene the requirements of allotment of shares. For deposits, it is not a contravention because any amount received from state government or central government is not considered to be, it's considered coming under exempted deposits. A very interesting issue comes, let us say we have advance received from a customer, which is outstanding for more than 365 days. It becomes it comes out of exempted deposits. But if such an advance is received from another company, I will put it as amount received from another company and still call it as a green deposit. So what I'm saying is, if any of the items come anywhere, I mean anywhere in the 18 lists, although it comes under one and it is breach of one, but it is okay for something else, then that okay makes it green still. In that sense, but allotment of shares, there is a control that within 60 days you have to allot after receiving the money. And maybe if you have taken special permission because it is from the state government, you can take that as an excuse. Otherwise, you are contravening that section more than the deposit section.
Okay, sir. One question is there any time limit for repayment of a deposit received from shareholders of a private limited company? Yeah. If yes, can a deposit be renewed by book entry?
No, sir, there is no time limit specified. There is no time limit specified. It goes with the agreement with the customer. It goes with the agreement. So the time limit we were talking about is whatever was grandfather. That means before 1/4/2013, that had to be repaid within 2 or 3 years. Now I don't remember that. That date has got over. But now repayment of deposit to the member goes by the agreement with the member. The deposit section does not say when it should be repaid.
So members can raise the question. It is, you can now unmute and ask. It is enabled actually. Anybody having any doubt can ask.
Sir, is the COVID-related expenses can be treated as CSR?
No, what do you mean by COVID-related expenses, sir?
Company spending for this COVID-related activities for
I put up that particular slide. I put up that particular slide to say what are all the expenses already covered. So COVID-related expenses generally, if it fits into any one of them, either for vaccination or for setting up hospital facilities all those things are considered, as long as it is not only to your employees. I would put it that way. I mean, some of the companies are now taking that for all my employees and getting it vaccinated. So that may not be coming under the CSR.
So regarding that audit trail raised by the question, not accounting software, but other things, I think it will cover in IFC, ICOFAR.
Absolutely. I told you that, the internal, for the purpose of internal controls, it is required. For the purpose of reporting on internal financial controls, it may be required, but then not for the purpose of mandate.
Yeah, thank you.
Any questions? Am I anything pending?
No, nothing in chat box is pending.
Okay.
Whether the ICOFAR, one more small question, whether the ICOFAR audit can be done by another CA or another professional with the help of this thing. So that is the using the work of an expert by the statutory audit.
You can definitely take the help of another chartered accountant or another technical person, because when it comes to IT controls and all, you must definitely take the help of an expert. But finally, you should own up on that particular advice, and you should also do your due diligence. The due diligence of whether whatever he has done is correctly done, whether whatever he has assumptions or whatever he has taken inputs is all proper. You can definitely rely, but finally the responsibility will be on you to opine. The final opinion has to be given by the statutory auditor only. And yes, you can form the basis of another person's expert opinion to form your own base.
Thank you, sir.
Thank you.
Thank you, sir. Thank you, Gururaj, Acharya, sir, for elaborating in details the important amendments relevant for the assessment for the year 2021 and also CARO and other aspects. Thank you so much, sir, for the excellent presentation, as always, and enlightening our members on the subject. We have a very good registration today. That is a process 240 actually. Once again, sir, for happily accepting our invitation to be the faculty. Now I request Secretary Rama Sharma for the formal vote of thanks.
Before that, I would like to just add, sir, thank you very much for an excellent presentation. Your name should be Rajaguru Gururaj Upadhyaya. Wonderful, sir. Thank you very much.
Thank you, sir. So thanks for the kind.
Thank you, Chairman, sir. Respected Chairman of Trivandrum branch of ICAI, CA Ramesh Kumar S. The very learned speaker for the day, CA Gururaj Acharya, sir. My fellow committee members, other senior members, and all other members who are present for the session. A very good afternoon to all of you. We really had an excellent session on the various aspects of the Companies Act, which is very relevant for the purpose of audit. So we had, like our chairman said, we had an overwhelming participation. We had around 240 registrations, and throughout the Zoom meeting, we had over 100 participants. So this itself gave us a clear idea that the seminar was a grand success. So thank you, sir, for spending your valuable time with us and spreading and sharing the knowledge to us. You are indeed the Gururaj and Acharya for this particular topic. We are all very sure about that. Next, I thank all the members of our branch for the great participation and the patient listening throughout the session. And we are also very happy to know that all the programs are being welcomed by all of you. So it gives us more encouragement to conduct and plan more of such programs. Like the chairman said in the beginning, kindly feel free to call any of the COVID task force members in case of any emergencies. Also, next week, we have planned for a CPE meeting as well as a study circle meeting, the details of which will be informed later. So to conclude, I am again borrowing the quote which is being said by Jomon sir at the beginning. Let us all be hopeful by being careful. Surely this phase too shall pass and we will see dawn. So let us all pray to God Almighty to heal all these happenings in the world and bring us a better tomorrow. So Loka Samasta Sukhino Bhavantu. Thank you all. Thank you for the patient listening. Thank you, Gururaj sir, once again. Jai Hind and Jai ICAI.
Thank you, Rima ji, and I apologize for your
Thank you, sir.
all of us for not being your child. I could see your child was missing you.
No problem. No. No issues at all.
Sir, some technical error. So technical problem, I couldn't disconnected, sir. Sorry for the, sir.
No, not at all. I think we had a good time. Thank you so much.
Thank you, sir. Thanks a lot.
Thank you so much, sir.